Good afternoon. Guten Tag, bonjour. I mean, we're in sort of French and German lingo here as well. A warm welcome to the 7th and largest and second day edition of the CV Summit. Welcome to the audience. We're here live. I know people are coming, and we've got so much outside as well to look at. So please do come in, sit down, and enjoy. So warm welcome to you who are joining us for the second day, and welcome back to all of you who were here yesterday. And of course, also a warm welcome to all of our online viewers who are joining us from all over the world. I hope you're prepared for this second day. Yesterday was the first day. We had really, insightful, relevant, and dynamic conversations here on stage. A lot of thought leaders from all across the blockchain and Web3 industry were here to really talk about all aspects of blockchain. Just to give a bit of a summary, we talked a lot about that it's now about utility rather than speculation, that this is a new era of adoption that we're stepping into, but also that the maturity is really increasing. We also talked about that the crypto winter that we're currently in is not only a challenge, it's also a possibility for both the crypto sector and also investors to take a step back and to sort of reflect and also see which of the projects are really here for the long run. And then we also talked about redefining capitalism. We looked at tokenization. We looked at physical. We also looked at this being a technology that can really enable a better future. But that it's also about that we don't know, we don't have the answers. We are also learning along the way. And that collaboration is essential for this to really progress in the right direction. And also education, because we're learning new things all the time. This is an exponential, field of technologies. So education on all sides is so important. And that's hopefully also what we can convey with a summit like CV Summit. I think I have someone who's actually more insightful, both to the CV Summit and what we want to achieve and what we talked about yesterday and what we're going to talk about today. So I just wanted to quickly welcome him up on stage so that he can also share with us his insights. And I'm talking about the founder and CEO of CVC, Mathias Ruch. Please come in. Here we are, day 2. Yesterday was amazing.
It was really great, very insightful. As you said, we were looking at different aspects in our ecosystem. I'm actually very glad today that our world is still standing. Everybody had a successful merge. Ethereum is now proof of stake, so I'm very happy.
Exactly, that's applaudable. That's a really good way to start. Finally. And what would you, there was so much conversations yesterday, so it's difficult to maybe, really give a good recollection, but what sort of stuck with you? What was the essence of yesterday?
I really think that I keep getting back to your clarity, because I think that's really something that is very to the point what we're experiencing right now. I remember, when the day came to an end yesterday, we had the panel where, let's say the new world. I remember you introduced Google as a traditional company. I think that buzzed them a bit. But you could see that you have the Google's Visa entering the space. It was very insightful. And then you can also see that the early movers in Crypto Valley, really the pioneers like Bitcoin Swiss, that they come to the next stage, and they showed us how they are going to tackle that.
And they also showed us, the reason for traditional companies to really emphasize how, traditional in the way of being traditional, really is also so open to both collaborate, learn, and facilitate, the blockchain technology, which is also interesting to see.
Absolutely. It struck me. You have a giant in technology like Google, right? Yeah. And Google probably hasn't been that visible or vocal about the space, but when you listened yesterday where they stand and where they see the potential, they're just lining up, they're just, creating connections, and you can see that this is really becoming big and arriving in the mass adoption stage.
Definitely, and just also to mention, Google and Visa are here, right? So if you want to, please go up. It's sort of above where the NFT gallery is. So go there, speak to them, and sort of learn more. And you also have the startup founders who are also here. There's so much happening.
Exactly. That's on top floor, right? Yeah. And then you can go up to the balconies where you have the partners. You can talk to them. They're all here. We have the startups that can, give you insights what they are doing at the forefront of innovation. So yeah, it's multifaceted this year.
Yeah, and if you would say one thing that you're looking forward to today, because new discussions, new learnings, and new insights.
Very much looking forward to today because it's quite diverse. If you look at the agenda, we're gonna dive into CBDCs. That's a topic that that's everywhere today. We're diving into Africa actually, which is very interesting because you can see the true use cases of blockchain when you tap into that continent. The metaverse is a big topic. That's something that I'm very much looking forward to. So I think there's something for everyone.
Mathias, thank you so much. You'll be back on stage to give me a summary at the end, but enjoy in the meantime.
Happy to. Thank you so much. Enjoy.
Round of applause for Mathias. So just briefly, for those of you who maybe weren't here yesterday, just briefly about me. I have the pleasure to be here today to facilitate us for the second day. And I'm born in Sweden, bred in London, lived and traveled over most of the world. And my career is very multifaceted. I'm, of course, a moderator, a communications catalyst, a speaker, and a TV host, but also a passionate, driven entrepreneur. And I'm also in the Web3 space, which makes it even more interesting and relevant for me to also be able to facilitate all these conversations. And I'll tell you more about Planet IX that I'm working with later today. But I wanted to refer also to what Mathias talked about, because I mentioned a quote yesterday that was, "In the world deluded by irrelevant information, clarity is key," to sort of give us a navigation to have in mind. I thought today I'll give you another one, and that's from Albert Einstein. At least it's said that he said this, and that is, "Creativity is intelligence having fun." So with that, maybe we can have that as a navigator today. Open up your imagination, let the inspiration flow, spark your creativity, and really indulge in hopefully intelligent conversations here on stage, but also have fun. Go out and mingle and network in the breaks, see the NFT galleries, the metaverse, and all of you viewers online, use the Brella app, as all of you here also can do, and book up meetings, reach out to people, because this is, an opportunity to also reach out to each other. So that's one of my urges for today. So, another thing I mentioned yesterday, to be a bit repetitive, is after having been in this city, Crypto Valley, for just a couple of days, I've realized it's a beautiful, unique, historical, pittoresque town, and also such an epicenter for blockchain. And it's amazing to see, the founders and the startup initiators and so forth. And it really proves a mature industry, passionate founders, and of course also a dedicated president of the city of Zug. So with that, I want us all to give a warm welcome and round of applause to the president of Zug, Dr. Karl Cobalt.
Dear participants, as Mayor of Zug, I would like to give you a warm welcome to the city of Zug. Our city has been very successful, actually, throughout the last few decades. The Financial Times recently named it the best positioned micro city for the future worldwide. A year ago, I spoke in this space about the pandemic. Today, we are facing a new crisis, as we know. The war in Ukraine has changed the structure of geopolitics and has a major impact of almost all regions in the world. If you consider the exploding prices for energy, you will judge these effects as negative. Moreover, we see ourselves even threatened by an electricity shortage. Energy-intensive blockchain technology must also deal with this problem. And it does. The fact that at least one cryptocurrency provider has announced that will be able to operate its blockchain with considerably less energy than before clearly shows your industry has a future for sure. The city of Zug has been working with blockchain technology for quite several years now. It has applied to various services. At the Swiss Economic Forum in Interlaken a few months ago, It distributed non-fungible tokens, which met with great interest among the Congress participants. I am sure you not only like the future-oriented Zug, but also appreciate the locational advantages of other sorts. If you stroll through our beautiful old town, you find very nice places to be and restaurants, and you will certainly feel how well tradition and modernity match here in Zug. And having this in mind, I hope you will find your way back to see us again. Thank you very much. I wish you now many exciting lectures and networking conversations. Thank you for being here.
Thank you so much, Mr. Cobalt, and thank you for everything you're doing for the city of Zug. So the maturity of blockchain technology is key, as we've spoken about, and adoption is imperative going forward. And it's been also showcased many times by the conversations we've had that Crypto Valley has many solid players that can really serve institutional players globally on crypto trading and right service providers. And our next speaker is going to talk more about crypto trading fundamentals in the Crypto Valley. Alex Casimo is the co-founder and CEO of Portofino Technologies, and that's a crypto-native startup building financial infrastructure technology to further enable digital asset adoption, and they're also building high-frequency trading, grade technology for digital assets. Does it sound exciting? Are we awake today? Does it sound exciting? Some energy? Good. Just to have some energy. Feel that you're with us. Okay, so give it up for Alex Casimo.
Thank you. Hi, everyone. Thank you very much for being here. I have some slides that I'd like to run through today. So I'm Alex Casimo. I'm the COO and co-founder of Portofino Technologies. Portofino Technologies, we're a startup building market infrastructure technology for the tokenized economy. We're high-frequency trading specialists, and we deploy our tech to market make on centralized and decentralized crypto exchanges. Now, that's what we do now. But in the future, we think we can do so much more. Now, the reason for that is what HFT does. HFT allows for the frictionless exchange of assets. Now, blockchain, at its core, every action is a transaction. And as a result, we think that our tech can play a key role in the ecosystem as it develops further. Today, I wanted to touch upon two things. One, why crypto trading is such an interesting and attractive business, and two, why crypto trading firms that embrace and build fantastic technology will play a central role in our market going forward. So, why are crypto trading firms such attractive businesses? Well, our market is very big. We trade around $150 billion a day on crypto exchanges. To give you an idea, that's about 3 times the size of European equities. And we've still got a long way to go, a lot of growth ahead of us. On the product side, for instance, we don't really have a listed options market today. It accounts for less than 5% of daily volumes. In traditional finance, 30%. Then, institutional adoption is going to be such an important theme going forward. Crypto has historically been a retail domain when it comes to trading. Coinbase famously had 80 or 90% of their exchange volumes that are attributable to retail. This was back in 2018-19. Now we're sub 30%, but in most asset classes in traditional finance, it's between 5 and 10%. So there's a lot more to go. And the market structure really favors trading firms and really favors trading firms with fantastic tech. Now, disintermediation obviously is a theme that's very important for our community. And disintermediation also really favors trading firms in our market. If you think about crypto trading, you can have end users that are onboarded to the main exchanges. And these end users can range from very large institutions all the way down to retail. This in traditional finance would be unheard of. The cost of onboarding and trading on NYSE, we're talking about millions of dollars. And that's just CeFi. In DeFi, end users can interact peer-to-peer. Now, as I said, for trading firms, being as close to the end user as possible brings big benefits, but for end users, the benefits are also large. They have greater proximity to trading firms, better pricing. Our market is also very diverse when it comes to liquidity pools and has high complexity. Companies that solve these problems with tech, that generalize away the complexity, have a huge advantage. And tech trading firms have been the ones that have built this tech in our market. My company, Portofino Technologies, is connected to all of centralized finance, all of decentralized finance, is able to trade thousands of different pairs, all with our proprietary tech. So why is that important? Looking forward, why is that more important? Because of our market. Well, here it's helpful to think about the history of the web. Web 1 was famously described as read-only. So it was natural that the companies that helped organize content won, so Google. Web 2 was read-write. So again, natural companies that facilitate the posting of content won, so Twitter. Web 3, read, write, own, so all about ownership of assets, ownership of content. Now, ownership doesn't mean much without transferability, and our technology is built to facilitate transactions, transferability. So where do we think this tech, this trading tech, this HFT tech can scale across the value chain? Well, our view is it can scale across the entire market infrastructure value chain. Some of the most exciting companies that you'll all be very familiar with, particularly in the exchange space, were actually built on top of HFT trading tech. A lot of the verticals here behind me, they'll look very familiar, so maybe let's talk about one of the more crypto or blockchain-specific ones. It's a business that we call token banking. Now, this is where Web3 projects require services, they require advice on where and how to list their tokens. Now, again, in traditional finance, that is a particular process or project that's reserved for the largest companies in the world, waiting to IPO, and they would employ hordes of investment bankers and consultants to help them along the way. In our market, when these companies want to list on Binance or Kraken or FTX, they come to market makers, they come to firms like Portofino Technologies. There's no reason to think why trading firm tech should not be applied to any asset which is on-chain. So as the NFT market evolves and progresses, we fully expect trading firms to take a central role. I wanted to finish to just touch upon three main business lines of Portofino, so you get a feel of what a trading firm organization looks like today in our market. Well, we market make on centralized and decentralized exchanges. We provide execution services to institutional clients over the counter, and we provide token services to young Web3 projects that wish to list their tokens on exchange. Beyond that, we spend a lot of resource supporting the ecosystem. We invest in young Web3 companies. We give them infrastructure and resources to help them build their product. Thank you very much. Thank you for being here and braving the terrible weather outside. And I'll be in the lobby later on, should any of you have any questions. Thank you.
Thank you, Alex. who will also be back in our panel shortly, because now we're going to continue with this topic, but dive into the theme of looking at global crypto trading from the Crypto Valley and allowing us to get insights and perspectives from solid players in the sector. Now, our moderator for this panel is Salama Belgali, and she's head of business development and partnerships at Bitenc. And if you don't know what they do, they're one of the leading crypto trading platforms and the inventor of the famous perpetual swap. And a fun fact about Salama, because some of the speakers I have fun facts about, she's happiest outdoors and when she's traveling and backpacking, but I'm sure just as happy when she's hosting interesting conversations like now. So please give it up for Salama and her panelists.
So Alex, that was a great insight into crypto trading infrastructure from the perspective of a liquidity provider. So I don't know about you guys, but I'm super excited about this panel because this is a unique representation of crypto trading in the ecosystem. And before we dive into the discussion, before I present my panelists, I would like to know who here today with us is trading crypto for institutional investors. Raise your hand. Okay, I see a few. That's very good. All right, so I'm going to start by introducing Alex again for those of you who missed his keynote speech. So Alex Casimo, COO and co-founder of Portofino, a crypto-native startup building financial infrastructure technology. Mark Banner, CEO and co-founder of Covario, an independent crypto prime broker for institutional investors. Carlos Martin Doncel, head of digital asset product strategy at Swissquote, first bank offering cryptocurrencies trading for its clients. And Adrian Fritz, research associate at 21.co, the parent company of 21 Shares, the world's largest ETP issuer, and as of last week, a double unicorn. Welcome. So the crypto landscape has been plagued in the last couple of months by terrible events. We've seen troubled waters with several events like the toppling of Celsius, and you name them. And in the meantime, we also were, all of us, very nervous about the ETH merge. I mean, until this morning. Thanks the heavens, everything went fine. I can still not believe it, but let's see. So my question to you, Alex, in all these troubled waters, also when you consider the macroeconomic environment, which is very challenging, that's the least we can say, how do you manage all this market craziness?
Yeah, thank you, Salama, for the question. It's been a very busy year for us at Portofino Technologies. You're absolutely right. The macro environment has been tough. So we have inflation, we have war in Europe, supply side issues coming out of COVID. So broadly speaking, all risk assets are off, and all risk assets are off by quite some. You know, US publicly traded tech, it's down a good 40–50%. So we shouldn't despair that our market is also off the highs. I mean, if I actually remember, our market was quite resilient at the beginning of these macroeconomic difficulties. We had one very idiosyncratic event, which was Terra Luna, which kicked off a chain of other issues regarding Indeed, Celsius, Three Arrows. For me, the big takeaway there was that there was a lot of impropriety in our market. People built products too quickly, and that tends to happen when you have a big technological revolution. It's basically the opposite approach from what we took at our company, which was to focus very carefully on how our systems were built, operational excellence, having proper risk controls for our trading systems so that we can trade a lot of volume, a lot of coins in a completely automated but very safe and market-neutral manner. Practically, what did we see? Volumes are off the highs, spreads are higher for some particular markets, but we think that this is just a temporal thing and it will come back. Regarding Ethereum, I think probably split the response into two parts. There was the prep for the merge, which there was really a lot that happened there. And then, as you rightly pointed out, since this morning, it doesn't look as though there's been all that much, unless things have drastically changed in the past 45 minutes. And anyone in the audience, please shout if that is the case, because I probably need to run back to the office. So in preparation, I would say three main things that we noted. One, speculation in preparation for the merge. Two, new products being listed on exchanges. And three, some operational complexity. A few words on each. Speculation, we saw the carry trade come back. People went long Ethereum Cash, short the future, with the idea of making an additional yield when receiving potential forked assets. New products being listed. We saw proof of work futures listed on a lot of derivatives exchanges, and that was basically a barometer of how people think that hard fork will fare. I think yesterday was trading something like 2 cents on the dollar. And operational issues. The big question mark that we were toying with over the past couple of months is just what to do with our ETH balances, particularly when they were held with third parties, because you had this new asset that would be created, and there were question marks over how it would be handled. I think they're probably the main points. Salama.
Thank you, Alex. Anybody wants to add to that? Maybe, yeah, Mark?
Sure. I think definitely the last 6 months have been quite entertaining in not always great ways. Probably the best news over the last 6 months was this morning that the ETH merge went through smoothly. I think particularly on the institutional side, everyone breathed a huge sigh of relief when there were no real issues. And the fact that it was boring, to quote Paul Krimsky from Cumberland, is probably a great adjective and also a great thing. I think the last 6 months, you mentioned Celsius, we're obviously actively involved there. Keith, our Chief Risk and Compliance Officer, sits on the creditors committee, so we're quite close to that situation. But you also saw, Three Arrows and other situations that perhaps didn't need to happen. But as all financial markets evolve, these kind of things do come up from time to time. This happens in traditional finance, and it's not a surprise that it happens in digital assets. And what I find most reassuring is that the market has been robust and resilient at the back of it. So yes, we find sort of bad behavior or perhaps less desirable behavior, but the market has found a way to work around it. And I guess the other point is on the DeFi side, unlike the CeFi venues, the DeFi venues actually did exactly what was written on the tin. The contracts are a contract written in code, and there was no violation away from that. Rather, DeFi showed that transparency in the leverage markets, the financing markets, is actually a very, very good thing. And it was actually the lack of transparency and the reliance on pure trust that is what the CeFi venues failed from. So I think that we'll probably see over the coming months more of that sort of shift into more code-based trust as opposed to faith-based trust.
Well, it's great that you're mentioning DeFi because I was just reading an article in Decrypt which was saying that actually Europe became the biggest crypto economy in the world, and that was driven by institutional clients getting into DeFi. So we've seen actually crypto growing thanks to retail, and then it seems like the institutional clients feel they have this like FOMO feeling, oh, we also want to join this party, guys, so we're coming. How do you see the volumes shifting from retail into institutional money, let's say?
I can start. I mean, we're an institutional shop. We don't deal with retail, and definitely we see institutional volumes, though they've come off a lot over the last few months, the interest has actually grown considerably over the last few months. Our client onboarding activity has skyrocketed in the last 2-3 months alone, and that's in the face of these issues that you guys mentioned. So I think institutional adoption continues to grow pace. They see more comfort in some of the regulatory issues that are coming in, and I think we're going to see volumes coming from the institutional side coming in on the back of that. But yes, it will take some time for people to figure out, how they want to position themselves from a risk perspective. But I guess
yeah, Carlos, I see you moving on your chair. You want to say something?
For us, it was a little bit splitted because we were focusing mainly on retail at the beginning, and our institutionals were mainly issuers of different financial products that were starting to see the light thanks to the newer regulations coming. So the advantage of having the licensed bank is that you essentially are in the top of the pyramid in what concerns to licenses. Again, still, we faced also some difficulties concerning volumes. The good thing, no third-party, let's say, noise happening around us. So that's nice also to have it. But on the other hand, what is funny is actually the number of cryptos in unitary terms is going up every day. I think when retails are down, institutionals are taking the positions. When retail is up, institutionals are following the positions. So we see an overall market trend where unitarily more crypto are being bought, but the prices are not, for the moment, going towards the same direction, at least. But yeah, and for us, we feel that we are in a unique position also. So that also brings their own challenges because we, for example, cannot be as flexible as all the people in this room in order to execute certain businesses, but it gives us also the possibility to have direct contact with regulators, a more custom approach towards them, and the regulations that is needed here and there. So I don't know, I guess we are more or less in the same line, I think. Yeah.
Adrian, do you want to add something to that?
Absolutely, absolutely. I can speak from a ETP issuer standpoint. Obviously, volumes have been coming down quite significantly. But I think what's really interesting to point out at 21 shares is obviously the AUM came down as well with all the prices. But in terms of net new assets, we actually saw inflows this year, over 100 million year to date. If we look at our client base, I would say it's around 70 to 80% institutional investors. And let me define institutional investors. It's really our, I would say, family offices, independent asset managers, hedge funds, or private banks. And it's just really surprising how sticky the AUM is. And it also shows that we have more players like that have a long-term conviction.
Cool. So we've been going at pretty much high level until this point, and I would like to hear, and I think people sitting in this audience as well, they would like to hear what type of services you're providing concretely. Who wants to take this one?
Well, I guess you just spoke
I
about
just
yourself.
Go ahead, guys.
Yeah, happy to talk about Covario. For us, the core services are the institutional brokerage services. So that's focusing on agency-only execution of trading, agency-only financing, and then, of course, custody. And we also support sub-custody for those who want to use a third-party custodian. The key for us being that we are that independent, agency-only, safe pair of hands in all markets. And you've seen that through these last markets. During the most volatile days, we're always there. We're able to name a price. We're able to execute our clients' trades and make sure that our clients are looked after and don't have any issues. In good and bad, as I said, we're representing our clients in the Celsius case. So there's another example. But I think fundamentally, the services that we offer is that sort of institutional prime service.
For us, it's more split in between retail and institutionals, as we define it here. We started with retail and then going up in the echelon. So first trading, then custody, and now staking also. And in parallel to this work being made for retail, where we developed our platform, etc., on top of our, let's say, knowledge about the general markets in the TradeFi environment, we are also now building our own exchange. So that will also bring some innovation to the space, I think, to the crypto valley, because there's no other players that have such a weird mix of business lines as being very proficient in the FX market, but at the same time offering a crypto exchange, all inside inside of a bank figure. So that's also a key point for us. And now what we are is expanding our line towards institutional. So we started first actually with issuers of ETPs, ETNs, and now we are also expanding towards external asset managers that are extremely, and I don't know you guys if you feel that way, extremely interested in this. So it's now becoming, I think, a key point for any private bank or relationship manager that has his own boutique. For them now, it's like basic to have at least some portion of the portfolio invested. They also, as a side note, usually prefer spot now rather than other type of products, now that the laws and the regulations are becoming more specific toward digital assets, and also tokenization, which is one of the biggest topics that is probably coming now with TradeFi players, tokenizing everything, and then we will see what kind of economy or what kind of new businesses can appear from that space also.
I learned something new with you, Adrian, today when you mentioned that 70 to 80% of your clients are actually institutional. For me, 21 shares was like, okay, that's for retail, but maybe you want to tell us a little bit more.
Yeah, so as you mentioned, 21 Shares is the largest ETP provider for cryptocurrency, exchange-traded products. And for those guys who are not familiar with the ETP structure, what we basically do is we wrap all our beautiful digital assets, Bitcoin, Ethereum, many, many more, in a regulated financial product and list them on stock exchanges. So we at 21 Shares, we really see us as the bridge between traditional finance and the crypto world. And our products are that, I would say, they're such in high demand because it's really the easiest way to get exposure to the crypto world. So all the institutional investors that I mentioned, family offices, independent asset managers, and so on, they're familiar with the ETP structure. They might have their problems with the underlying, but like this, it's just the easiest way to buy and sell those products. Those products have an ISIN number. They're listed at the SIX stock exchange, Xetra Frankfurt, Euronext Paris, Nasdaq Sweden, and many more. And yeah, and that's why I believe if you're a traditional investor, ETP structure could be an optimal way to get exposure. What I have to mention here as well, sorry, because we recently announced our parent company, 21.co, and I'm proudly can say we're double unicorn status. We're 21.co is our parent company now. 21 Shares obviously is known as the ETP provider, but 21.co is also the parent company of Amoon. Amoon, on the Amoon side, we're building DeFi token because we believe in the long run, those two worlds will eventually converge, and that we also have financial products all be traded on the blockchain.
Beautiful, it's very visionary. Alex, you've been talking a lot before, and you gave a lot of insight about what you are doing. Is there anything else that you would like to mention at this point to the services?
I don't really want to take too much of the wonderful audience's time on this. I mean, maybe I would say one thing. Institutional services are, the different flavors are vast. So, you know, Mark sitting next to me has a very specific product which is targeted to institutions, and it's a trading product that's drastically different, really, to what we're doing at Portofino. And we need more and more serious companies that will come into the market and offer the variety of services for the different institutions that intend to enter, because the complexity isn't just trading some crypto or holding some crypto. The complexity is, you know, I want to transact a basket of crypto, or I want to transact versus a particular index, or I want to transact $20, $30 million of this particular coin that only trades $40 million a day. That's where the complexity comes from with institutions. And that's why you need so many different firms that are tackling the market in slightly different ways.
Cool.
If I may add one last point, and I think it's really important to mention, we're from our side, we're also heavily grateful and dependent on the underlying infrastructure that is being built. Obviously, with our ETPs, we work with market makers, APs, custodians, because otherwise it wouldn't be possible. So that's really important what's happening in the back end as well.
And that's why we call it the crypto ecosystem, right? Because nobody can exist without the others. We're all interdependent on each other, right? Okay, so how about we go a little bit more granular on the market? So how does it look in terms of concentration, derivatives, DeFi versus CeFi? You started mentioning that, Mark, if you could just give us a little bit more color about it.
Yeah, sure. As I mentioned earlier, I mean, what we are seeing is that the DeFi product offering is very, very attractive. In terms of transaction, I think you'll never get away from sourcing liquidity from liquidity providers, market makers, such as Alex's firm, as well as some perhaps centralized exchanges for certain types of products. But the decentralized exchanges and the smart contracts that underlie them have just been a revolutionary concept. And I think folks like Portofino have been very adept at blending those two sources of liquidity and price offerings together, so that they can really distribute risk throughout the entire ecosystem in a very efficient way. And I think that to me has been a big shift over the last 2 years. And then I would say that, certainly the last 6 months, the attraction to DeFi, particularly from a lending perspective, has just been far greater than what you've seen. And obviously with the merge now, it should be even better. Costs should be lower, and therefore attraction should be higher. So I think it's just fantastic.
Carlos, from your perspective?
Yeah, for us, conceptually, for DeFi, it's like a parallel infrastructure that runs independently, as you can call it. You can use it for in different ways. I guess for us, the most important part is the lending part. Because in the end, the problem is the efficiencies, again, because you need to over-collateralize in certain amounts. Now there's a lot of progress concerning credit lines in the blockchain, but again, the complexities, I think, are huge. The good thing also for DeFi, it's attracting a lot of talent from finance. And I guess for me, being so early in the space, what I was always missing, having a professional financial career, but in the same time being in the ecosystem since 2010, was that you were missing these finance guys. You were missing people like you, actually, with a background of complex high-frequency trading, from algo trading. So there's a lot of people now doing that shift. And I guess innovation is we are just seeing the tip of the iceberg in what concerns DeFi. Again, there's new challenges. The frequency where you need the refreshes, etc., needs to be done in a certain way. Also, there are a lot of players that don't have, for the moment, the infrastructure part can represent also a barrier of entry. Again, lower than banking or financial traditional services, but still a huge barrier. So that's why, for example, a bank like Swissquote can interact. But yeah, and in general, I see professionalization, I would say. This is and finance really entering the space. But crypto is also giving new products towards finance. And I guess future perpetuals are the best example. So I think both ecosystems independently can learn from each other, and at what point, I guess, it will be completely merged, again, the word of the day. And it will be just normal to Bank of America to interact with whatever other bank from Thailand and bypass SWIFT and things like that. I guess those are the main points and trends.
Adrian, you started mentioning Amun and your projects in DeFi. Can you tell us a little bit more about it, or?
I mean, again, I think just to add on this, we also think that those two worlds will come together eventually. I think both worlds can learn from each other. I think until now it was a bit more like camps. But I think what DeFi is really good at is revealing all the inefficiencies in traditional finance, while at the same time, I think DeFi can learn a lot from traditional finance as well. I mean, there's many years of experience, many trial and errors. So I think DeFi can learn from that world as well. Why I think it's going to be successful, and I totally agree with you, Carlos, is just the talent that comes together. I can see it on every conference. We see it internally. We really have this mix of traditional bankers coming with people from big tech, and a lot of people that work with passion and love for this industry. So yeah, future is hopefully bright.
Alex, from your perspective, you're also market making for projects. So you certainly have a very nice insight into that.
Yeah, I mean, so most of our trading activity is still in centralized finance, just because that's where the bulk of the volume is, right? So on the big centralized exchanges, you have 90% of the volumes, and the rest is in DeFi. So centralized exchanges, what do they look like? Well, it's a very concentrated market, but it also has an enormous tail of very important actors. So the top exchange in the world, Binance, accounts for something like 50% of volumes. Then there's 5 or 6 that account for another 40% of volumes. And then you have an enormous tail of exchanges, but it's not a market that's ossified. It's moving around all the time. FTX is a great example. 2-3 years ago, wasn't a company, now it's number 2 or 3. I forget. You have some Asian exchanges that have exploded by listing altcoins and getting a lot of retail interest off the back. So it's a moving market. Now, DeFi, around 5-10% of overall volumes, a lot more in spot than in derivatives. I think it's higher in spot, 15-20%. And there's 2 main types of market. There are AMMs, and then there's decentralized exchanges with order books on top. So the former is a real innovation. Haven't really seen anything like this before, and has some very specific use cases that are interested. The latter actually looks and feels a lot like a centralized exchange with an order book. The settlement layer is obviously very different, though, because it's directly on chain. So as Mark pointed out before, we connect to both worlds. 2 very different technical solutions to do it, but very important in order to provide a single entry point into those different liquidity pools.
So we've got 3 more minutes to go. Any questions? Because I can throw you this fantastic mic. Anybody has any questions? Oh, okay. That's going to be a challenge. 1, 2. No, it's better. Trust me, it works.
Oh, that was close.
Okay, it doesn't.
Sure. Right. So my name is Dario, and the question for, I guess, the Mark and Alex is: derivatives markets are traditionally a huge part, multiples bigger than whatever underlying markets there are out there. What kind of crystal ball information do you have for us on how those markets are developing for crypto?
I guess I'll start and then jump in. Yeah.
Go ahead.
Look, I think the crypto derivatives markets kind of grew thanks actually largely to BitMEX, and their innovations, and over time they've started to sort of converge towards what we normally see in traditional finance. I think you're starting to see a lot more institutional adoption of the derivatives markets, particularly as regulated players start to come in. So CME futures have obviously picked up a considerable amount of volume over the last couple of years. And as these other larger players become more trusted, so Binance's liquidation engines become a little bit more reliable, BitMEX's as well. But I think what we see is that you need the sort of less regulated exchanges to be innovators, because that's really, it gives them the freedom to do so. But you also need the highly regulated players in order to get real, the multi-trillion asset managers to get them to start playing. And also the largest banks, they're prohibited, of course, from trading on the less regulated exchanges. But as this whole ecosystem grows, you'll just start to see that innovation staying at the less regulated venues, and then the traditional venues picking up more volumes. And I think we definitely expect that volumes on the traditional exchanges should eventually dwarf spot by many orders of magnitude.
It's consolidation and innovation. Those are the 2 layers, I guess.
Yeah.
Where the players will distribute themselves.
Exactly.
So we have 1 more minute. There is time for another question. Anybody else? No? Okay. So then we're going to have a closing note, maybe. about how the markets are going, moving going forwards. Who wants to take the lead here?
I guess I can go. So I would say more serious firms entering the space, more fantastic people entering the space, specific to trading, greater volumes, lower spreads, and yeah, I'd say that.
Yeah. Yeah, we talked to the largest banks and the largest asset managers in the world. All of them, even through the last months, have continued hiring and growing their digital asset teams. Most of them, or many of them, are sitting on the sidelines trying to understand more. So I definitely concur with what Alex said. I think we're going to expect more entrants, very large entrants in the market over the coming months and years. So I think it's definitely heading in the right direction.
Exactly the same, actually. For me, it's the final consolidation phase, because you feel when you're in the space for so much time, it's always, this year it will be finally the consolidation, because this player, X, Y. Again, I guess the next year is going to be the most interesting one. We'll do have the bigger names, the big asset managers, and let's say the big money entering this space with the consolidated, their consolidated status.
So I'm afraid we're running out of time. So thank you so much for this brilliant panel. Thanks for the audience for showing up today. And thanks for CB Summit for this opportunity. Thank you.
Thank you so much, Salama, and thank you to the panelists for conveying all of your knowledge and everything that you do going forward. Thank you. So, as we know, and as we spoke about, the Ethereum merge is done, and this implies that the switch to proof of stake is completed. And this is, of course, opening up for a new era for the second biggest blockchain. And it's said that more than 99% is going to be saved in energy consumption for the validation layer. And if I read or heard the right amount of magnitude of energy that can be saved on a global level, the speculation is about 0.2 to 0.3, which is, has a great impact. And as sort of much capital has been on the sideline, one would say, during this time, bearing in mind the energy consumption, it will probably imply that the managers of a lot of capital will most likely go in and spend it also on ETH. We'll see. But the reason I mention this is that we're now going to listen to a keynote that is about liquidity during the crypto winter. Now, market liquidity, order book depth, and also fair price discovery is something that is managed by the market makers, who have a profound role in these elements and are instrumental also to an efficient market. And here to talk more about liquidity during a crypto winter is Alain Kunz, who is Director of Business Development, GCR. Now, Alain is a builder, and he's also a domain expert on the national and international crypto and blockchain scene, having also worked for a variety of investment banks and the financial services. So he really has a lot of knowledge to convey on this. So help me give him a warm welcome up on stage to Alain.
Hello, and welcome to the CB Summit from my part. I mean, when we consume media today, there is like one topic which seems to be dominating, and it's actually climate change. And in the last few months, I have been asking myself a lot in crypto land, where's actually the climate change happening? Because it feels much more like we're in a cold, freezing, dark crypto winter. Anyway, my name is Alain, and I work for GSR, the biggest and the leading market maker for crypto out there. And I'm not here to talk to you about climate change. We're going to talk about the bear market, crypto winter, and liquidity, and how it is interacting, and why liquidity is a bit different in crypto markets compared to normal financial markets. But let's start out with something positive with respect to winter. We're all in Switzerland, we got beautiful mountains, and in winter we all can go skiing. More precise, we are actually in Zug, Switzerland's heart of the crypto valley, a place where blockchain technology and crypto is king. At the same time, it is also the birthplace of Ethereum. Ethereum is the second largest crypto asset out there by market cap. At the same time, it's actually the main actor in the most important event happening. I mean, to be frank, it happened a few hours ago, the merge, basically the move from proof of work to proof of stake. It worked very well. It seems to be very boring, which is, with respect to technology and upgrades, always something nice to see. But the merge was also the thing lifting up and upholding all the markets in the last few months. It was also a source of a lot of hopium for backholders beside the crypto winter. It was basically the dominant narrative. Now, if we go 1 year back, it was also September, but it was still summer. We had Ethereum trading around 3K, we had Bitcoin mid 40K, and crypto winter was really far away. We didn't even have to run up where Bitcoin went up to 69,000 in November, and the world was good. Fast forward today, different levels, different environments. I mean, we're far away from the 3 trillion market cap we saw in crypto assets, a fraction of it. Depending on what prices or volumes you're looking at, a lot of it declined 50, 60, 70, 80, 90, 99.9%. And at the same time, we had bigger crypto entities like Celsius, Luna's UST, Voyager, 3 Arrow, and much more going bust or ending up in financial troubles. On top of all this crypto idiosyncratic challenge, we have a land war in Europe, which is not a pleasant thing. And at the same time, we have globally central banks combating inflation, which they caused in the first place. They are combating inflation by increasing rates, making the price of money more expensive. This puts a lot of stress on all risky assets out there and leading to a massive reduction in liquidity. Now, you're probably all wondering, what's liquidity and why I'm here to talk to you all about liquidity? The reason is very simple. Liquidity is key and crucial, and sadly, something that often gets overlooked in the space. When we look at the market, we want to see liquidity because it's essentially a feature. It's a feature of a well-working, well-functioning market. When we drop liquidity, we mean the ease by which one asset can be converted to cash or another crypto. It's essentially the possibility for you to quickly buy and sell without causing too much impact on the price in the asset itself. You can imagine it as a trade-off of at what price you can sell an asset and how fast do you actually can sell it. That's general, but when we now look at crypto market, liquidity is even different. What's the big difference to the traditional market where it's a nice to have if you have high liquidity? In crypto land, liquidity is part of your infrastructure. No liquidity, no token, no protocol. It's very simple. If you want to use most of the protocols or projects out there, you will at least have to acquire the native token. In some cases, you have to acquire multiple tokens to actually use it. That's different to financial markets on the traditional side that we know. Let's make it a bit less abstract. Let's take Tesla. If Tesla crashes, and I don't mean the car, I mean the stock, everything is still very fine. I mean, Elon Musk is probably going to be unhappy, but your Tesla is still driving you from A to B if you have enough battery or you can charge it. But if we do the transition to crypto land, there is a relationship between the liquidity and the technology itself. You need to access the token to run the protocol, making the liquidity of the token itself imperative to the technology. If you cannot access this or you cannot access the sufficient amount of token you wish to, you won't be able to use the protocol. That's bad. If you're a consumer, you don't get what you want. And if you're the owner of the project, it's even sadder because you have interest in your project, but you get new people joining that kind of ecosystem. So every time when we talk in crypto about improving liquidity, we also mean improving the infrastructure. In the context that we want to make your token more accessible, more tradable, reduce slippage, which is generally important in all kinds of market environments we can be in. But it's more important even in a crypto winter. Why? Because we will have low volumes, we will have tricky price discovery, we're going to have high volatility. So it's very crucial for you as a token issuer that you take charge of the liquidity of the market structure of your token. What do I mean by that? On one thing, you want to make sure that the order books are deep enough, that spreads are tight, that the interaction with your token from the people out of your community stays present and pleasant and nice. And the other side, it's also a powerful signal out to new kind of investors, that you show them you understand their concern, that it's important that you can enter a market as well as exit it without paying let's say, a discount or a premium in form of slippage. So it's really key to that. Now, if you're already a project, you probably realize that we are in crypto winter. Very simple, fundraising got very harder. The market cap that we vaporized is scaring away new investors, and retail is still licking the wounds from all the CeFi blow-ups we had. But let me tell you something, winter is still a great time. It's a good time to build. That's some kind of coping meme we have. But there's also a great time to launch a project. Why? It seems to be counterintuitive, but you have much less noise, you have less destruction. At the same time, you have less competition for the limited attention span of the investors you actually want to talking to. Now, Uniswap, CertiK are two projects which went that path and ended up being huge protocol. Like everything in life, it's important with who you partner with. So if you found a protocol, your co-founder needs to be vetted, whoever you build the technology with needs to be vetted. And it's also important that you find a partner out there that helps you develop the market, can guide you through liquidity, explain it how it works, entangle the labyrinth of sexes and dexes. And that's our core expertise at GSR. Since 2013, and believe me, we have seen 1 or 2 or 3 winters come and go, and somehow we survived it. So we have a lot of insight to share with you, help you to go through that crypto winter. And if you know not a token project itself, but you're some kind of trading counterparty, and you're facing the challenge in sourcing any kind of liquidity, happy to be here. Feel free to reach out via homepage, any other medium. We're happy to help. Now, before I let you go back to the conference, if you just take one thing away from my 7 minutes plus I took away from your life, is essentially liquidity. When we talk about crypto, that kind of technology is vital, because the token is essentially what will make the protocol work. So if the token is not accessible, it's not liquid, you are gating your project, and you're putting your project, the odds in a bad way that you succeed. So I will be around the event later. Feel free to chat me up and talk a bit more about liquidity. Thank you very much for your attention.
Thank you so much, Alain.
Thank you.
And as Alain said, it goes for all of the speakers here on stage, that they're all going to be here during today. So do reach out to them if you want to continue conversation or have any questions. And of course, the same goes for our online viewers. Do reach out via Brella or send a comment in the chat. So as we've heard both today and tomorrow, blockchain has the potential to revolutionize banking and finance. But has innovation led to the emergence of too many blockchains, to liquidity fragmentation and an interoperability challenge? This is something that our next speaker is questioning, or at least asking the question to see if this is the case. Alexander Kech, many of you met him yesterday because he was in the opening panel that I hosted. For those of you who don't know him, he's Director, Blockchain and Digital Assets at Citi Ventures. And he now joins us to talk about what I just mentioned, but also what could be next for CBDCs, for bank coins, stable coins, to become part of the future of banking and finance. So please give it up for Alexander Kech.
Okay, so my speech will be an introduction to actually the panel that will take place just after these 7 minutes. And it will be about the next, what we believe at Citi is the next critical step for CBDCs, bank coins, and regulated stablecoins. You won't see a Citi logo on this slide. We're not talking about a Citibank product or Citi Ventures product. It's really an industry initiative that I will share about with you today. It's called the Regulated Liability Network. But before going into explaining what this is all about, Let's start with a quote from this gentleman, Charles Sanford, who used to be the CEO of Bankers Trust in the 90s and is considered an expert in risk management. And his view of the future of banking and capital market in terms of how money and collateral should move around was pretty much a definition of what Ethereum is today or blockchain is today, a 24/7 system which remove completely counterparty risks, or at least reduce counterparty risks, as well as transactional risk. And effectively, blockchain has this potential to create that 24/7 settlement network that all financial players and individuals and corporates can use to better manage their money. But in order for that to be a reality, we need to see out what is money today and where are we with the emergence of new formats of money such as stablecoins. So we are today in a world where sovereign currencies are in a way in competition with new types of currencies, non-sovereign currencies, like Bitcoin, for example, so cryptocurrencies, but also stablecoins who are backed by fiat currencies in a private issuance mode. These are all interesting. They are different types of monies. Central bank money, as you all know, is what banks would be using for settling transactions with one another, and what you're using in your wallets, meaning physical wallets, the cash that you have in your wallet is central bank money. Commercial bank money, which represent probably 70% of the money in circulation around the world, is what banks are creating through debt. That's your deposits that banks have with the reserve that they need to keep around 20–25%, depending on circumstances. And then you have electronic money, which is a bit more recent. It's e-money service providers, such as PayPal, etc., PSPs, payment service providers, who issue that money. It's generally backed one-to-one with real dollars in a bank account, and is redeemable for one-to-one with a US dollar, a euro, or a Swiss franc. Very similar to what stablecoins have been in terms of issuance, one-to-one backed by US dollar or euro or Swiss franc, and also redeemable one-to-one. And then cryptocurrencies, you all know about it. We don't need those different currencies to compete, because our view is that it will be there. All of those type of payments will stay. But what we are afraid of, or what we want to avoid at a bank like Citi, servicing customers around 80 markets, as you can imagine, is having fragmentation of liquidity due to central bank digital currencies or tokenized commercial bank money being issued on different blockchains, different platforms, and being not interoperable. We don't need that war between formats, because the way an instrument is represented doesn't really matter. As long as the legal structure of that instrument, which is money in this case, stays the same, you can really make it evolve from a paper ledger a long time ago to a traditional database like we are managing money today in banks and central banks, to a distributed ledger. It doesn't change what money is, it just changes the way money circulates. So let's not fight over how this money should circulate and say this one is better than the other. We should not move to blockchains or whatsoever. On the contrary, let's embrace this amazing technology that blockchain is, and make it the new way, the new settlement platform of the 21st and 22nd century. So what is the regulated liability network? So at Citi, a very smart individual called Tony McLaughlin, you might have heard of him, with his great Scottish accent, came up with the idea of, do we want to implement 88 different CBDCs and 88 different blockchain, not interoperable, cannot be used for cross-border transactions? Do we want JP Morgans to issue tokenized commercial bank money, JP Morgan coins, and then Citi coins, and then UBS coins, all on different platforms? Imagine the nightmare this will be for corporate customers using those different coins. Do we want stablecoins to be issued on thousands of different blockchains, breaking liquidity across different technology layers which do not talk to one another? And we know how chain links are not yet mature enough in a way to deal with these diversity of blockchains. So what about the regulated world of banks, central banks, payment service providers, and stablecoin issuers, when regulation will properly regulate their issuance, get together and create a FMI, financial market infrastructure, that supports all those currencies or all those forms of money on one platform or on a set of interoperable platform, not an easy word. So that's the regulated liability network. So where are we with this plan? You have a white paper that has been published in 2021. And in 2022, we've been proving the concept and piloting the concept with multiple other bank partners and central bank partners. It's been evangelized, I would say, as a concept to most central banks, the BIS, for example, as well. And there are today 2 pilots happening in the UK and the US, with more to come. There was already a proof of concept in Singapore last year. And the idea is to validate the concept, both on a legal point of view and on a business point of view, and see what if one day such an infrastructure exists, how it should be organized and created. And also, of course, see how technologically we can implement this and have some conclusions in terms of should it be a public blockchain, a hybrid, a private blockchain, and so on and so forth. So if you want to know more about this plan or this RLN, Regulated Liability Network, there are a lot of reference material that you can take a picture of and read. You just type Regulated Liability Network on Google, you'll find a lot of articles. What I want to conclude with is to say that, yes, it might look like a pipe dream and something that is not possible to achieve, but, well, that's what pretty much everybody was saying before SWIFT was created, now connecting 11,000 financial institutions, probably going into difficult and rough times because of blockchain, but still, they managed to do that in the 70s. That's what people were saying also from when the idea of creating a network of cards that can be used across the world by multiple providers such as Visa, MasterCard, etc., was discussed. But it exists. So this is achievable, and at Citi we're convinced we can help with other banks and central banks and also stablecoins issuers in the long run achieve this objective. Thank you so much.
Thank you, Alexander. Thank you, Alexander, for giving us such clarity once again. So now we're going to head into a panel, and we're going to dive more into CBDCs, stablecoins, and their role in the evolution of capital and crypto markets. Now, to moderate this panel, we have Dr. Mathias Ratajgi, who is a seasoned investment professional with over 25 years of experience in senior management roles, mainly in the financial industry. And today he is founder and managing partner of Meti Advisory, which is a crypto advisory boutique. So give it up for Dr. Mathias and also his panelists.
Hi, everyone. Thank you for joining this panel and this conference. We have also, via video, one of the speakers, which I will introduce shortly. So it's great to see that we have usually, one-day conferences on CBDCs, another day of conference fully dedicated to stablecoins. We are going to do it in 30 minutes. Why? Because it's the CV Summit, first of all, but secondly, most importantly, because we have distinguished and very professional speakers today. I'm going to introduce them a little bit, beginning with Tina Baker-Taylor on the screen. Vice President of Policy and Regulatory Strategy at Circle. And Tina leads the Circle's government affairs and regulatory strategy in Europe and in the UK. She was previously leading operations and government and regulatory affairs at Crypto.com and Binance in the UK. Then at the end here of the row, we have Yves Longchamp. He started his career as an economist at the Swiss National Bank, and then moved to the private sector, he's heading the research of SEBA Bank since some time already. In the middle is, no, here close to me, sorry, is Oliver Sigrist. Oliver is an advisor to at the Bank of International Settlement, the BIS Innovation Hub. He has been involved in several experiments involving CBDCs, which were realized in cooperation with the Swiss National Bank and other partners. And then in the middle, last but not least, Julien Donnet. He's a blockchain product manager at Citi Ventures, and he focuses on bringing the outside into Citi. Cool. He comes from a consulting background and delivered service and products to the financial industry for the past decade. Now, just to set the scene, I've read that around 80% of the central banks are actually experimenting, planning, studying to implement CBDCs in some form or another. And a few of them, handful of them, have already achieved the implementation stage. And reportedly as well, I read that there are apparently 85 fully operational stablecoins out there, and probably as many projects being developed. So usually people point out the benefits of these innovations. Now, if you think about CBDCs, they are supposed to innovate at two levels, at the level of the relationship between the commercial banks and the central bank, and then also by substituting or digitalizing what we have in the pocket in terms of coins and banknotes, the central bank money. And the stable coins also promise a lot. In the universe of fiat payments, they promise to be more efficient, available 24/7, at the fraction of the cost that now are implied by fiat payments. Then if we move lastly to the cryptocurrency markets, the stable coins are much needed. I mean, they provide liquidity to transact between cryptocurrencies and also a store of value, temporary store of value, also because the pairs that you can transact directly in fiat are really a small subset. So against all these benefits, I would like to go around the panel here and ask, what are the challenges and the difficulties instead of the benefits in order to implement CBDCs and stable coins? Just to begin with, maybe with Tina.
Well, I think that the development of CBDCs is likely going to be an expensive and lengthy process. And from where we stand today, it appears that from a retail's perspective, it's largely with some unclear benefits that, governments are still exploring. Many of the advantages of CBDCs that are being, offered are already being provided today by privately issued digital money, including stablecoins. And I think it's also not clear that a CBDC will be able to meet the constant demand for innovation by the market, or that it would actually improve access and financial inclusion, given that in many cases, access to a bank account would still be required to use it. And by contrast, privately issued stablecoins, which are able to compete on the open market, have the ability to be more agile, tech forward, and, in my perspective, likely better equipped to kind of reach remote populations, going back to your comments about being 24/7. I think the other thing to recognize is the benefits of open source technology, as opposed to, the legacy type closed infrastructure systems that, are offered by private money today. So, for example, Circle today operates USDC across 9 public blockchains. And, that gives payment optionality, use case optionality that's really kind of driving net new economic activity. So since USDC was launched, for example, we have settled via USDC more than 6 trillion in transactions. So, I think that the early use cases around stablecoins will continue to evolve. And from a retail perspective, I think for me, the challenges still outweigh the benefits, especially when we think about things like privacy, access, and again, just the agility of the infrastructure.
Thank you, Tina. More on the CBDCs, Oliver. What are the difficulties that we need to overcome to unlock the benefits that are expected?
Yeah, thanks. So I think before trying to answer your question, I would maybe go a step back and first ask the question, what problem does a CBDC actually solve? And if we think about this question, you can think about it in terms of kind of the retail space or the wholesale space. So in the retail space, obviously, I mean, could be a response to declining cash usage. It could be a response to missing financial inclusion. On the wholesale side, it could be a response to the tokenization of financial markets, so a need of central banks to issue central bank money as a settlement asset because these markets become relevant, a relevant part of the financial ecosystem. So there are many questions to be asked, and obviously, I mean, it really depends on the use case. So a CBDC is a response to very different problems. Now, on key challenges, I think a few of them were already mentioned. On the retail side, I think one of the key challenges is actually the design. How is it designed? And I think there are 3 dimensions that are particularly relevant. Is kind of one is certainly a CBDC is not to crowd out any private payment instrument. So it should preserve the 2-tiered banking system. It should enable some form of privacy, as we know today, with the use of cash. And obviously, it should be secure. On wholesale, I think there are many questions related to kind of the plumbing side. So how is it integrated with other forms of central bank money? How is it portable or fungible across networks and stuff? So there are many questions. Yeah.
Maybe from SEBA research, Yves, what would you add to these difficulties?
Yeah, I actually the way I see that is, I think I will start first with stablecoin and then go back to CBDC. Actually, what I realize or what I observe is that DeFi really became important at the time you have a way to provide liquidity, and the liquidity was provided by stablecoin. And I think this is what makes DeFi possible. The problem with this kind of stablecoin, they don't have really real use, actually, except for speculation. So that's something probably we will address later. The thing is, if you start to create a financial system on the blockchain, finance by definition take risk, and not all the risk pay. Sometimes it doesn't. And then you will need to find a system if you want to expand the credit and to create credits, and maybe not to have all the stablecoin completely backed, but let's say to have the idea of bank coins, as Alex Cash just mentioned before. When you have this idea of fractional reserve, you need at the end of the day to have a system that can be stabilized. And if you want to stabilize, you need a central bank. And actually, the way to connect will be CBDC, because currently you have 2 universes, the sort of a crypto universe, whatever it means, and the traditional finance. And if you want to have both together, you need to have a CBDC, in my view. This is more from a let's say, financial stability point of view. And as we have seen, we can have crises also during the weekend. Think about Terra Luna. And if you have to wait until Monday morning for the SNB or the Fed to be able to provide you liquidity, I think that will be an issue. So in my opinion, I think it's key that we replicate the current environment that exists for money, with the central banks providing central bank money to, let's say, bank or regulated entity, and then this one can create their own stablecoin, like bank coins or whatsoever, to the public. And I think I'm pretty much for the idea of a wholesale. It's much more than retail CBDC. And the question is, obviously, do we want to have CBDC to replace cash? And then we have a lot of privacy. But if this is the case, and I think we have a lot of questions regarding KYC, KYT, AML, and so on. And then I will circle back to you, Oliver, but later.
Maybe, Julien, I mean, now we got more a macro perspective, right? I mean, you observe many projects, right, in your job. What do you think that the difficulties are there to come up and implement this project, more on the stablecoin side, perhaps?
So I think that first what is important to note is that it's very early in the development of CBDCs. Out of these 88 different initiatives, only 2 are live today in the Bahamas and in Nigeria. Mm-hmm. As such, the vast majority of the rest of them are still exploration and research. So we don't really know how it will evolve and what will be the shape of it in fine. But it's a good time to talk about, a common framework, standards that could benefit in the long term in terms of compatibility. So the main challenge for me will be interoperability. the fact that these different countries which are working on CBDCs would be able to devise something which is compatible between each other. Otherwise, it will be a nightmare for global banks, it will be a nightmare for the consumers and so on to be able to really use to CBDCs. In terms of form, I think that, as Yves mentioned, it will be mostly about wholesale because the job of a central bank is not to deal with wallets, not to deal with KYC, not to deal with the retail clients. So how we see things would be mostly that the central banks emit the CBDCs. The CBDCs are being used by the commercial banks to do settlement between each other. And then there will be another form of digital money which will be used to offer new options to either the corporate clients or the retail clients. This could be stablecoins as we know them today, but this could also be tokenized commercial bank money, for instance, which would be emitted by the bank themselves in maybe a token format, maybe something else. But in the end, all the options should be on the table and should be interoperable because I don't think we can have only one single option that will cover the whole use cases. So just to finish on the stablecoins though, I think the main challenge for the stablecoins are the regulation. At some point, the stablecoin issuers will have to be regulated to at least the same level as e-money PSPs, for instance. And as such, it will be interesting to see if it will affect the business model, if it will affect the processes, and especially for the decentralized protocols. Like how do you regulate DAI, for instance? Who's responsible? Who's liable? Is it the foundation? Is it the developers, the team? Is it the users that are minting DAI? All those questions are at the moment without any answers. So the next couple of years will be super interesting on that topic.
I certainly agree that, and I personally believe that the regulated providers of stablecoins are going to be the winners in the long term. It is hard to think that it can be different because there is so much pressure on the one hand from the regulators and the authorities. On the other hand, everybody feels more comfortable if they buy something that they know it's somehow regulated. I wanted to take advantage of the presence of Oliver, maybe for the benefits of all of us, to throw a bit of clarity around the geography of the stable coins. We hear a lot about wholesale stable coins, a lot about retail CBDCs, and wholesale CBDCs and retail CBDCs. And at the same time, also, it's not clear how many of these use cases or projects rely really on the blockchain technology or are just not, in fact, an expression of the digital money. So you certainly observe this geography very well. Can you explain to us what's going on?
Yes, I can. And I think many aspects have already been mentioned before from previous panelists. So when we think about CBDC, of course, we already talked about that. So there is the wholesale space and there is the retail space. Now, globally, there is growing and quickly growing interest in retail CBDC. So there is both on the research side, but also on the experimentation side, there is a lot and growing interest. Wholesale CBDC projects are more, I would say, tilted towards developed economies. Switzerland is a good example for that. So projects Helvetia and Jura, that where I was personally involved in, are two wholesale CBDC projects. Then we have on the second, I think, important dimension is the differentiation between kind of the stage of development. You have projects that are very early stage development, and I would again mention the wholesale CBDC experiments from the Swiss National Bank. These are really experiments to learn, to test feasibility. And there are others, like Julia mentioned before, that are already live, so retail CBDCs that are live. And I think that the third key dimension is, and that's what you mentioned just before, is technology. So a CBDC is not necessarily a DLT-based, token-based form of central bank money. It is just it's just a digital currency, and it could run both on centralized technologies or on DLTs or blockchains. Now, if we think about the kind of the projects that the BIS Innovation Hub has been involved, so far it's mostly blockchain related. Now, how this is going to develop is very difficult to say. I think experimentation for sure will continue. There is a lot still to learn, and I said before, we are at very early stages of the development. That's my view. But then on the other hand, we will see very fast-moving economies like developing economies who have a real need for financial inclusion, for other reasons.
Yeah, this brings me to a complementary question actually for you. Developing economies versus mature economies. Do the developing economies have an advantage as a kind of starting point, which is an advantage because of the nature and the structure of their economies when it comes to CBDCs?
Well, possibly. What you often hear is this leapfrogging argument. So the economies with very poor infrastructure, they now get the chance to use existing or new technologies to implement their CBDC, and that is actually one way to leapfrog kind of the developed economies because their systems, they are working, they are efficient, and it's very difficult to actually change these to change, and it's also not a good idea to change these systems and processes from one day to another. So that's maybe my take on that.
Good. Let's go back to London and to Tina and to the stablecoins. I mean, you are operating a major crypto stablecoin, as we all know. Do you feel the competition heating up out there? And also, what do you see as the challenge in maintaining your position or even growing it? Can you give us some insights?
Sure. So I think we can all agree that the last several months in the crypto markets have been pretty tumultuous. But what we saw was it almost acted as a bit of a stress test. And the outcome is, kind of the proof is in the pudding that sound business models and a pro-regulatory approach for stablecoins, fully reserved, backed one-to-one stablecoins can prevail. So, I think that fully capitalized, well-regulated alternatives to other types of stablecoin models, similar to USDC and Eurocoin. Circle launched a second currency in June. Really, we saw a flight to trust and quality amid the turmoil earlier this year. But also, I think a demonstration of how the market itself can kind of shield, prudentially from, the prospect of bailouts, for example, across the broader crypto economy. So I think for me personally, the correction period that we've seen also is really an acknowledgement that stablecoins are in fact not created equal. And this kind of opens the doors for use cases to expand. Gartner produced some research late last year that speculated that 20% of businesses would potentially be using stablecoins by 2024. That's I think a huge number in a short period of time. And we see that already happening today with USDC and with Eurocoin. So, in addition to the crypto capital markets, we're seeing, a real evolution in global payments, especially cross-border remittances. And as you start to build out a portfolio of products or currencies, then you can continue to offer that same quality across multiple different currencies, and then potentially create very effective foreign exchange corridors that operated at the speed of the internet, where today they don't. So I think the last thing I'd say with, you know, the opportunities around this and what that looks like for Circle is the real explosion of net new economic activity that we're seeing that's kind of stemming from these device-centric, always-on payments. And if you kind of think ahead, the dollar really props up trillions of dollars of other economic activity. And so if you had a stable coin that's, you know, responsibly managed, trusted, regulated, does that then serve as the basis for the digital asset world to host, you know, a whole host of new economic activities on top of that? And so that's where the infrastructure piece comes in. And so I think when you look at what Circle is doing and the opportunity to set not necessarily Circle apart, but certainly that kind of responsible, regulated, one-for-one reserved stablecoin model apart from the others, I think you start to see that as a competitive advantage. And so from a challenge perspective, you know, I think that we can all agree that regulatory clarity has been a challenge for digital assets broadly, but certainly for stablecoins, as it starts to converge with and bridge into, you know, the traditional payment space, that regulatory clarity that we're seeing coming out of MiCA will be, you know, a real benefit to you know, trading and payments activity in the European bloc. But there's also legislation being undertaken in the UK to integrate stablecoins into the payment system. And we expect to see a piece of legislation, you know, this year, this side of the election in the US, that has real valuability of moving forward in Congress. So I think taking all of that in the round, it's a real indication that stablecoins are important, that they are becoming prolific, and the importance of, you know, operating one that instills trust and confidence in the market.
On that note, Julian, do you invest in stablecoin projects?
Like personally, yes, but
No.
in the office, let's say,
Citi Venture.
no, Citi Ventures is a corporate VC. We usually invest in you know, picks and shovels companies that have already a working product and that would you know, either provide infrastructure solutions or compliance and KYC solutions. And we usually try to invest in companies where there are synergies with our own business and that we can use internally, that we can also maybe develop partnerships and new kinds of products. So the short question is, short answer rather, is that no, we won't invest at the moment into companies that issue stablecoins, just because it's not really the ethos of.
But how should the project, the stablecoin project, look like to get your attention?
So I guess that if a project linked to stablecoins is properly regulated, which has also already some traction, which has the approval from, you know, the OCC and different regulators, then this might be an option. But I don't see it coming before a couple of years, so that, you know, the bankers are already more knowledgeable about the topic and will be more confident to look at it.
So project developer, be informed. No, maybe a question for Yves, and then to open it up to all the panelists and maybe as a closing discussion, but looking forward. I mean, this panel was about stablecoin and CBDCs. It is okay like that, because I think that going forward, both will somehow be around. And therefore, the logical question is, how can they coexist? What kind of relationship should they have? How should that be organized? Is it possible at all that they cooperate? Ideally, of course, we would like a system where stablecoins and central bank digital currencies entertain a relationship that is virtuosa, as we say. So what's your opinion, Yves?
Actually, I think I briefly mentioned already this idea. In my opinion, what I say that there will be a transfer of the current organization, traditional finance, with central banking, and then you have commercial banks that provide their deposit, which is a sort of electronic currency that actually doesn't exist. I mean, there is no, you cannot feel it. So it's, I would say it's as a stable coin where you don't see it anyway, and there is no kind of backing except the balance sheet of the banks behind. So there is no liquidity into it. And then you create this kind of change in liquidity. So I think you need to have both of them, because I'm confident that a good financial system must take risk, because in the long run, risk gives you a lot of reward, but sometimes it doesn't work, so you need to have someone that provides you liquidity when needed. And this is why actually central bank exists. And I think that I have, so maybe I'm too much in history, but I don't see how you can create a stable system without having anyone with big pockets of money and have the ability to print if needed. And I'm not sure that the crypto financial system will be better in that situation. So I think that they need to coexist. And I think that they will coexist anyway, because I think that banks will enter into the space because they have huge benefits from themselves. First of all is the FX market, because if you have a stable coin, actually for banks is all about FX. FX is the biggest market, and then trade is settlement, which is the premise of blockchain, and this is a big advantage for banks. And finally, you need to have an end consumer. And if you have a bank account, and you can open it maybe with your apps, then you can pay wherever you want. So you have also the payments. And I think that this current not central bank, but I mean commercial bank with a key role in the world will play an important role in developing and preparing the user interface. They have the background and they know how to deal with money, because this is what banks are doing. So I think at the end of the day, I think there will be a good coexistence between CBDC, wholesales, and kind of bank coins to coin the new words that have been created today.
Julien, how do you see the cooperation between or interaction between these two stable coins and central bank digital currencies?
I mean, I think competition is healthy. I think it's also beneficial to have different options, different ways to transact financially. As Alexandre said in the previous keynote, I don't think it's a winner takes all. But the main point is really to have fungibility between the different options, to be able to transfer wealth from one to the other layer and to do it seamlessly and in a frictionless way. So the name of the game for me is just really like interoperability. Yeah.
Oliver, maybe rapidly, because we have to listen to Tina as well, but are the regulators really open to include and cooperate with stablecoins?
Well, I don't know. I mean, I think we all agree in this room that a future monetary system may be programmable, may be composable. And what we don't know is whether it also will feature CBDCs. If it does, I think it will coexist with private forms of money as it does today. So then, I mean, for sure, there will be coexistence and there will be convertibility of CBDCs and central bank money if the ecosystem matures. I think it will be very similar to what we see in today's financial system, where we have coexistence of commercial bank money and central bank money.
Good. Tina, rapidly, do you agree with that?
The two can't coexist. And from my perspective, I think that there is a future payment system where a privately issued stablecoin that conforms to regulations and can support a Visa level transaction throughput and uptime and nation state level security and assurance is coming. Over the long horizon, digital currencies that are able to operate within the regulatory boundary and within licenses that allow privately issued digital money to operate with reserves potentially in the care of the central bank system itself, provide optionality that our payment system needs. But these might then have the important guardrails that kind of create the bridge between public and private money going forward. So yes, I agree that they should exist together and aren't necessarily in competition.
Good. With that, I would like to thank you, the audience, but also the fellow panelists here that have contributed to this panel discussion. Thank you.
Thank you.
Thank you. Thank you. Thank you. Very good.
Thank you so much for truly relevant and insightful aspects of looking at CBDCs and stablecoin and their evolution. So now thank you also for all the patience and also being so acute listening. It's now time for a break until 3:30, but do come back because we're going to dive directly into yet another topic that will be relevant and interesting, and that is around NFTs and DeFi, compliant DeFi. And I also want to say, even though you're walking out, do go to the NFT gallery. It's absolutely amazing. There are NFT artists there. Do go to the Metaverse. Check out Google and Visa and also the amazing startups. And don't forget to mingle and network and re-energize. So enjoy. a warm welcome back. A warm welcome back to the second day of CV Summit. A lot of interesting, relevant, and hopefully clarifying discussions on stage yesterday and also prior to our networking break. Are you all feeling energized now? All of you that are in this beautiful theater casino? Good, thank you. We feel that you're here, we feel your energy. There's so much going on out there, so I'm also really happy to see that there's a real buzz out there. But I'm also ecstatic to see that you're also pulling yourself from there and also coming here to listen to really relevant conversations that, of course, all of you are relevant to be part of. So do also, there will be time for you as an audience to ask questions. So do, seize the opportunity. And also, like we said earlier today, seize the opportunity to reach out to the speakers and panelists while you're here. Because now everyone's centered here, then that's a great opportunity. And of course, also warm welcome back to our online viewers. You're as important as everyone else here, and we're so glad you're taking the energy to view us online. And do also use the Brella app to reach out to the speakers. So before we went to the break, we had a really great panel discussion on CBDCs, stablecoin, and more. We're now going to dive into DeFi and NFTs and really look how DeFi and NFTs can also blend and get insights on how NFTs are able to standardize the building of decentralized infrastructure in order to establish compliant standards and meet regulatory requirements. Now, this panel has a title, DeFi, the Good, the Bad, and the Ugly in 2022, and the Dynamic NFTs and Compliant DeFi. And here to introduce this panel is Ronald Coggins, who is an experienced partner and lawyer at MLL. So give it up for Ronald and his panelists.
Okay, so welcome everybody to our panel. Good to have you here. I'm happy to host this panel about the good and the bad of DeFi, and also to talk a little bit about dynamic NFTs and how they interact with DeFi, on how they can make the industry better. I mean, DeFi was a very hot topic, especially 2021 and also a little bit in 2022. And basically, for me as a lawyer, what is DeFi? It's like doing traditional finance, not anymore on agreements, but do it based on code. So it means that it's fully decentralized, it should be autonomous, and that should also provide additional security and trust for all the participants. Now, we have also seen what can happen in DeFi. We have seen the bust of Celsius Network. We have also seen what happened with Three Arrows Capital, but also with Luna. And of course, that also raises the question, is DeFi failing? Does DeFi not work at all? And I'm happy that I don't have to answer these questions because I have two very well-known experts that can dig into the details. And so I would like to introduce you to Rashid. And Rashid, maybe you can tell a little bit something about you.
Yes, thank you, Ronald, and hello, everyone. So my name is Rashid Ajajan, one of the founder and CEO of AllianceBlock. So what we are trying to do is really to bridge the traditional finance and decentralized finance with not only being able to build the infrastructure and standardize the way that people can have access to DeFi, but also having a huge focus in the compliance and regulatory requirements, specifically on what will happen like in 2024 with MiCA regulation. And we know that there is huge potential. So if we want to have unleash the potential of DeFi, we have to be compliant with the regulation currents, but also the regulation that are coming. So yeah, this is where we are.
Thank you. And then I also would like to have welcome here Micha from Bonk.
Thank you. Very happy to be here. My name is Micha Rohn. I'm a software engineer and a long-time blockchain advocate. We just launched a new project, which is Bonk, the advent of self-sovereign finance. And what we're trying to do is to be regulatory compliant, of course, because we're based in Switzerland, but also to allow anyone to actually use DeFi in a more secure way, because it will be, custodian-led or non-custodial. And happy to talk about these subjects today.
Thanks. So, Rashid, maybe we start with you. We have seen there was the DeFi 1.0 wave, but we also have seen that it doesn't really work out because there was a meltdown of Celsius, there was a bust up of Luna. So is that not the proof that DeFi actually doesn't work?
Yeah. So no, this is a really good question. So like if I come back a little bit before, like after 2018, before it was really about speculations, non-fundamental. Then we started to see institutional money come into traditional and centralized exchanges. But then we saw like Etherland, which became Bancor. We saw Balancer, Uniswap, which are decentralized exchange. We show Aave, Curve, and all this lending protocol. And actually, this is where we started to see utility because people will be able to borrow money, to lend money, and having really interesting yield. And this is what we start calling yield farming, staking, and all these terms in DeFi space. But basically, yeah, so it's deposit, taking yield, and like traditional financial and institutions, so the yield from where they are coming. So then we saw players specifically like Celsius, which is basically a centralized lending protocol. So people on the decentralized space, they will go, they will provide their money, stable coins, and then what Celsius will do, it will provide them yield. And this is where there is the trick, because it's not the problem from the technology, because DeFi has opened huge, amazing doors that can be used like in line with also what is happening on the traditional system. But the lack of compliance and regulations, and this is what makes Celsius, instead of basically like securing the money of retail, they were playing DeFi degenerate. So instead of locking this and not using the money, because if I want to use the money, so I need to have EMI licenses, I need to have like different type of licenses to be able to act on behalf of my clients. Celsius, they didn't have any of these licenses, and they wanted to generate this yield for their clients. So what they have done, they started to put into Encore protocol, into Luna, into different lending protocol. And then when we had this huge volatility, they didn't have enough collateral to be able to keep up in the lending protocol. And they blocked the retail to be able to take out their money. So this is how they lose $500 million. So the technology, it's really something that has opened doors, but it was misused by decentralized player. For 3 Arrow Capital, they were one of the biggest crypto hedge fund in the world. So up in the peak of the bull run, it was around $18 billion, which is quite huge. But the problem is they have done some really bad trade because they have lots of things that happen that make Arrow Capital go in of what we heard lately. But they have lost around $500 million, but just because of Luna. And they have done also, if some of you learned about GBTC, which is the grayscale Bitcoin, they thought that it will be converted to ETFs, and they were waiting for SEC, what they will say. And actually what happened is that it was the GBTC and BTC, so GBTC is kind of tracker of BTC, and there was a discount between the BTC and grayscale BTC. And when there was the decision that it will not be converted to ETF, they have lost huge amount of money. So again, they were playing about their clients' money to be able to generate huge yield, and everything was beautiful in the bull run. But when we started to see like this huge problem, like the volatility and BTC going like dumping, so they lost a lot of money. And this is what people start asking, okay, is it DeFi the problem? So actually DeFi is not the problem. The actors are the problem.
Okay, but Micha may be asking you, the code itself cannot generate yield, so is it not required that you take out money, do something with the money and promise people yield? What are your thoughts on that?
Well, actually, no, the code is the one that generates the yield because the yield is baked into the protocol. If you look at, Aave, nobody needs to do anything in order to generate yield. You just put your money in, and it's, self-sovereign in the sense that you own the key, you own the tokens. And I think this is what has gone wrong, is that we mistakenly thought that Celsius was a decentralized protocol, but it was very centralized. And that is the big danger, is that the users cannot make the difference between decentralized and centralized protocols and fall prey to this kind of, it's not really a scam, but to this kind of actors. And we saw with Terra Luna that, DeFi is in its infancy, and we need a risk model. Every project needs a risk manager to be able to know when is it riskier, what is happening in the market. And we think, well, we did a lot of research with Bonk about risk models in crypto, and it turns out there are very few and far between.
So, picking up the word again, Luna, Terra. I mean, that was a DeFi stablecoin where also people said that's safe, it's proof because it's based on code, but it nevertheless lost peg and it busted up. So, Micha, in your opinion, what would a collateralized stablecoin need that nothing happens like happened with Luna? So I think your protocol also has a stablecoin. What are you doing differently?
Thank you for the question. Well, the big question is, how much is your collateral worth, and what is the risk of it not being worth anything? Because in every over-collateralized stablecoin system, like, well, Terra Luna, but also LUSD from Liquidity, you have a collateral that is set aside and that guarantees that the stablecoin can always be redeemed against a certain amount of value. What went wrong with Terra Luna is that it's a bit like pulling yourself up by your own bootstraps. You can fake it for a time, but it doesn't really work. And once the bootstrap snaps, then, well, you fall. And it is very important that the protocol that issues the stablecoin does not control the issuance of the collateral that guarantees its value. I think this is the primary requirement, and the secondary requirement is that the people who manage it have a sound risk model and can tell the users, oh, now you can borrow 80%, sorry, the market has changed. Now you can borrow only 50% of the value of your tokens because the risk has increased.
Mm-hmm. Yeah, and I will add that like, in traditional finance, basically, when we are speaking about collateralization and lending, borrowing, so we have default probability models. We know what is the loss given default, and many kind of indicator, and specifically also that we will have to stress test to back test. So if we take the example of Luna, you have put in one token that has no fundamental. His value is growing basically because of the trust and the FOMO of people. So, and people knows that they will have huge yield because of UST, so they will buy Luna. They will put it as collateral, it will grow the value of Luna, and they will be yield. But the problem is we have just simple stress testing methods. We will be able to see in extreme volatility environments what would happen. So we see that the Luna, basically, it will go down, then people will try to get their money out, they will sell, and it will be this kind of circle that it will go absolutely. So to down, so almost zero. So I think this is something important that is not existing, and I completely agree with you. We need to have risk models, we need to have backtests, we need to have stress tests, and this is what we, and of course what we'll discuss about regulation and compliance, this is what will make DeFi even much better, and also deleting as much as possible centralized actors, like within the DeFi space, that can use the money on behalf of the users without any license.
Mm-hmm. I mean, what I deem interesting is that the DeFi space is very growing, and we have seen huge yields, and of course a lot of financial intermediaries and institutions like banks also thought about jumping in. But for me as a lawyer, it was always clear that's not that easy, because liquidity protocols, maybe it's money exchange, borrowing protocols, it's credit lending. Mm-hmm. So I then thought about how can you solve this problem? Is it permission DeFi, mm-hmm. where you have a same as, for example, Aave, but you just close it like Aave Arc. Mm-hmm. So what are your thoughts on that, Rashid?
So this is my own opinion and what I truly believe. So in terms of Aave Arc, is taking the same actors that are on the regulated like financial institutions that we will do in a permissioned way, okay? Which is not decentralized in a way because it's completely permissioned. And they will be able to lend between them and borrow between them. So recreating the exact same systems by using smart contract in permissioned way, in my opinion, it will not work. The yield and everything that is coming in DeFi is coming from the community. It's people that need money, that are lending, that are borrowing. So this is what brings DeFi to where we are now. So if we really want to be able to have DeFi that's like where institutional and retail coexisting and we see the benefit for both actors, we have to have an ecosystem which is still decentralized, but we need to be able to have specific kind of pools, specific kind of like lending pools or liquidity pools, where only that, those that are KYC'd, AML, for example, that will be able to provide liquidity. So if we take the example of Uniswap, when you have huge volume, you can get up to 0.3% in trading fees, which is, if there is really big volume, it's kind of like, yeah, it's good money. But institutional cannot provide money in these pools because they don't know who is participating on this pool. Is there people that are not KYC'd, or they are trying to do money laundering? So if we want to solve this problem, and we saw what is happening between Uniswap as well and SEC, okay? So what we try to do is to be able to create this whitelisted pool. So if it's decentralized, people can do it the right way, that is existing now. But on the other side, we can have whitelisted pool where people can provide liquidity without showing just the proof that they are verified. So they will go through KYC, they will go through AML, but they don't need to provide their identity. They just need to show the proof that they are verified. But if the regulator at some point is coming and to protocol and they told them, okay, we need to know who are the people that have provided liquidity, so the users have signed a disclaimer that they will be able, that they will show their data. So this is the way that I see that we can still keep the decentralization, with keeping it permissionless, having the retails and institutionals, having the benefit from DeFi without replicating the traditional into a permissioned way.
Okay, so you also see a role there for the financial institutions. And now, Micha, I picked up a nice term, is self-sovereign finance in connection with your protocol. How does that interact with the traditional finance and the financial institutions? What is that?
So the term self-sovereign finance has been coined because with DeFi and Bonk in particular, it's actually the user on their own can make use of the value of their assets. So you have an asset, let's say 10 Bitcoin, and you want to go on vacation. You don't have to ask the bank if they accept your Bitcoin as collateral in order to lend you money. You just lock up your Bitcoin in an account and mint yourself the money. And this is what self-sovereignty looks like, is you do it on your own and nobody can stop you.
Okay, so but
maybe
that also
added something, something also about how can the institutional leverage DeFi. So I can take one simple example, is certificates. So most of you know certificate is a simple instrument. It could be active managed certificate or certificate tracker. So back in 2016, Vontobel was one of the first banks that issued this, like a Bitcoin Rapid Certificate and Ethereum Rapid Certificates. And then I remember when we started to see how can you use yield strategies for yield farming that you can provide to institutional while using certificates. And there was a lot of legal uncertainties, because if I am lending money to a pool, I have to provide KYC of every person that is providing liquidity in this pool, which is absolutely impossible, specifically if we are dealing with AV, with Curve, Convex, and all this protocol. But now, we can have legal framework where institutions can buy these certificates depending on the risk appetite. That are, of course, there is term sheet, prospectus, stress test, back test. And inside this money, it's deployed into this protocol. And the legal framework is just by interacting with smart contracts, it is legal, basically, to be able to wrap these strategies in DeFi and provide them into certificates. And we don't need to do KYC AML. So now we are starting to see legal framework for institutional to participate in DeFi without having all the burden of the KYC AML with all these people that are in these pools, which is very encouraging.
But at the end, I mean, even with those products, someone has to participate in the pool, and maybe this party also wants to know, or at least have a chance to identify who can be behind something. So, Micha, another concept that is coming up now is dynamic NFTs. Is that something that could solve the problem of interacting with unknown people?
Well, it is part of the answer, that is for sure. I think digital identities are coming up. We see more and more digital identity wallets. And having these dynamic NFTs to act as aggregation of identity is a very nice way. I think the standards are being built to to enable self-sovereign finance in an anonymous but regulatory compliant way. But it's still very early days, so it's difficult to say.
Okay, so but the dynamic means basically that the NFT can update over time, and who then should issue these NFTs in your opinion? Rashid, maybe you?
Yeah, so if I could do step back, so NFTs were really known, so use case specific, doing digital art, Bored Ape, buying NFT without any utility. But we discovered, and like I think Chainlink was the first one that have issued this dynamic NFT, where you can have like some properties, and these properties can evolve. I have insurance, I have like an incident, then I will have to pay this, and so on and so forth. So we can evolve the NFTs based on some rules, okay? And then, so what is dynamic NFT? Dynamic NFT is just connected to some off-chain or servers that will be able to have this metadata, for example, IPFS, URL, whatever, and then it will be able to evolve. And now we are seeing that actually NFTs can also have this data inside, and we can have properties and restrictions. So how it will be used, so the users will be able to mint an empty NFT, completely empty where there is nothing. And then they will go through KYC AML. So this KYC AML, they will receive the reports that has been verified. So then they can generate proof that they have been verified, which will become property in this NFT, which, for example, KYC'd true, it's Boolean, and then which means that can give them the opportunity to provide liquidity into this whitelisted pool. And then I will be able to buy, like, let's say, an asset, digital asset, or NFT, or Bored Ape, or digital art, or to do lending, borrowing. But I will, every time that I will do something, my NFT, this dynamic NFT, can act as inventory. And then, with these properties and restriction, we can integrate OpenVAS protocol, for example. We can have FATF. We can integrate MiCA in complete trustless way. So if I take the example of Uniswap, I have a pool that required only people from Europe that are being able to provide liquidity and to trade. So anyone that is coming to Uniswap, he will have their Meta NFT with this KYC, and we will know that he is from Switzerland, he is from France, or he is from the US, that he is an accredited investor or not, that he is regulated or not. And just with these rules, we are able to say, okay, they will have access to this pool or not. So it can really create the legal foundation to be able to provide this compliant DeFi. And this is where we think the future is going.
Okay, but who should be this KYC ML provider? Is that then Uniswap itself, or is it you, Micha, or your company?
We already have accredited institutions who are allowed to perform KYC, that there are laws and rules around KYC already. What is required is that these institutions actually generate themselves a pair of keys and sign some certificates. That's all that is required.
Yeah. So I would say there are two things what is happening now. On the decentralized space, this is what they call proof of humanity. So people basically are certifying other people, which will never work with institutional, of course. But on the other side, so we've been speaking with private bank here in Switzerland and even investment bank, and someone need to go through KYC for the private banking. He need to go maybe through 3 months. And then if he wants to go to the investment bank, he needs to do his KYC again, AML. So I do believe that we need to have this proof of authorities. Every single jurisdiction, we need to have like multiple accredited KYC providers that will be able to perform KYCs, and dependent on the jurisdictions, the user will be able to perform his KYC AML with the right jurisdiction. KYC AML in Switzerland is not the same in UK, it's not the same in France. So we need to have these differences, and I don't think soon we will have like one KYC standard, because even within the jurisdiction, it's still banks, they don't accept KYC of each other's.
But are you then not losing the scalability if you have to have pools for every single jurisdiction?
So this is decentralization.
No, but I think this enables scalability, actually, because if you don't have the capacity, you can agree to someone else, someone additional, providing this service, and then you can grow. And I think today we don't have so much an issue with capacity, so having the capacity to perform the service, so much as the capacity to use it on chain. This is the big hurdle. We're lacking the bridge between the real world and the blockchain for identity. And once we have that, we could even sell real estate, residential real estate in Switzerland on chain. This is not possible today because well, we have all these laws that no more than 30% of the real estate may be owned by a foreign national and this kind of things. So this might allow all the use cases.
So time is nearly running up, but I have one final question that I'd like to ask to both of you, and maybe start with Mika, as you're already with you. So what do you think, how are retail investors better protected by authorities, enforcement, or by communities and ecosystems, or both?
I think we need communities and ecosystems that are trustworthy and that can protect the retail investor. And we probably also need the regulator to kind of chime in and say, yes, we trust in this community. But the community is better in serving because they have the experts.
Almost like we need both. So DeFi exists because of anonymity, but MiCA regulation is coming, FATF are coming. So we will need to have every single users that need to be able to be KYC, AML, to be able to be protected. But if there is centralized entities that are doing this KYC, AML, we can lose also the power of DeFi. So we need to be in the middle. So we need to have processes that are making the data of the users private, that are being verified, that can generate proof that has been verified, okay? And then they will be able to interact. But then, if there is a problem, regulator can always have access to this data and will be able to protect this retail. Because why regulation? Regulation always, unfortunately, come after when there is problem, but they are here to protect retail. So we need to be on the middle ground, not losing not having full anonymity, but not also having full the way that is coming on the centralized system. So if you are in the middle ground by leveraging also this the rules with these dynamic NFTs, by the compliance, the leveraging the MiCA rules as well. So this is, I think, what will make DeFi even much better.
Okay, so thank you very much. Unfortunately, time is up. It was a very interesting discussion. I enjoyed it very much.
Absolutely. Thank you very much, Ronald.
Thank you very
everyone.
much.
Okay.
Thank you very much. Thank you very much. So we're now going to transition into the world of the metaverse. Now, the metaverse, one could say, is both a vague, exciting, and yet complex term. And it has a variety of definitions. Some say, or most say, that the metaverse is a concept of a 3D universe that combines multiple different virtual spaces, allowing users to work, to interact, to game and socialize together in 3D spaces. Some say it's the future iteration of the internet. So what the heck is the metaverse? That is the title of our next keynote. And the person to deliver this keynote, who knows a lot about what the metaverse is and who will tell us why it's imperative for the industry and why it will also be financially viable. David Bundy is the chairman of the Swiss Nonprofit Association. He's also the head of compliance and the metaverse strategy, a regulatory lead at PwC in Switzerland. And it's also interesting to know that he's a gamer himself since 35 years, and he's been in the crypto space and the metaverse space for the last 6 years. And also, as we talk a lot about education and the importance of education in order to educate the masses, but also the industry, I also want to mention that he is sharing his knowledge in his spare time, teaching compliance and metaverse in Miami, Guatemala, Zurich, Lausanne, and so forth. So please give it up for David Bundy.
Imagination and the passion to drive and really go out and do the impossible things. I think that's something that is really beautiful of mankind. And you know, you don't have to wait or look at Jeff Bezos or Elon Musk. I mean, it's in all of us. If we think about paintings, about music, music, literature, movies, people just want to go further, just beyond the borders, beyond maybe the limitations of money or physics. So with the metaverse, I really think the impossible will be possible. The metaverse, the term, I mean, there are like two words.
And if we translate that literally, it's beyond the universe. What is important with so much noise now around the term of the metaverse is that the metaverse is an augmentation of our lives. It's not a denial, and also it's not an escape. What it is a big term, and this term is basically stands for 3D virtual worlds. So the most important element of these 3 virtual worlds is the individual sense of presence. It's the first one. There are others that there are like unlimited players, people that can move into the metaverse, or that when you go into the metaverse and you leave it and you come back, it has evolved, and that things are happening synchronously. But to come back to this first element of presence. So maybe you have teenagers going to school, and during COVID, they have been at home and watched the screen, and they had to do their education via Microsoft Teams. So science has already shown us that if students are in a class, if they are in this environment of education, that they learn better. So basically, a first step can be for teenagers to have a VR set on it. But of course, to learn, you don't only learn with your eyes. So also tactile is very important. So you can think about meta gloves or meta suits and put that on so that you have a second feeling. So now we could think, okay, let's go on a class trip to Rome with our VR set, with our gloves, with our suit. It's going to be quite warm, but it's not enough, right? It's far too limited if we stop here. What is really interesting about the metaverse is that we can go back in time. Let's go back to 312 before Christ. And let's think how the first aqueducts were built at the time in Rome. And we can start doing projects as a class for maybe a semester and so on. So this sounds maybe a bit like science fiction, but you know what? In Dubai right now, parts of the city are created with Unreal Engine computers right now. So basically that entire parts of the cities are simulated in a way that you see the flows of energy, the flows of traffic, of people. It's just massive simulations where we can learn quite a lot from. Of course, also, if we look at entertainment, there will be all other possibilities. Right now, we are watching movies. It's very linear. I think in future, it's going to be that you're going to jump into the movie and sit next to James Bond and just get all the impressions. Or you can just play the last 5 minutes of Michael Jordan's last game at the NBA yourself. All this is possible. Why do I believe in it? Well, very simply, because production companies right now, when they are shooting movies, they're already shooting the movies in a way that they collect all this information to be ready for the metaverse. Of course, there are plenty of numbers going around. So like 5 trillion, it's a 5 with dollars. It's a 5 with 12 zeros, which is basically the economic potential which McKinsey thinks for the market of consumer, for the consumer market. And so the numbers are quite massive. And obviously, right now, a lot of projects are about buying land, about when you have the land, about building like a pipeline of products and via NFTs, and then basically building an experience and building a community around it. But that's all fine, but I think we can go beyond. When we think about the metaverse, I think it's important that we don't are stuck in a way of copy and paste, that just everything we want here in this world, that we don't transport everything we have here in this world just on a virtual world, but that we think further. So who has the solution? And I've read a lot about that. Kathy Heckel has done great job, Matthew Ball, and lots of reports out there. Also on social media, I think you can learn so much. But at the end of the day, no one has the solution yet. And I find that's really fascinating. So the best way is really just to take these various elements, to read all that, but to start thinking yourself what the models are in the future for us all. To do that, conversations are key, and meeting people are key. That's why I founded MetaverseTalks. which is a non-profit association, to simply bring together people, experts, non-experts, who are interested in this topic and who want to foster together these ideas and basically just to make it happen. I've talked a lot about the opportunities of the metaverse and the potential, but of course, there are also challenges. Being a compliance head at PwC, there are some around privacy, about anti-money laundering, about IP, and so on and so on. I think governance is going to be very key because, like in any other topic, you can't transport or delegate the responsibility to some kind of a technology. You need to take ownership and be responsible yourself. So, and with that, I invite my next speakers to speak about the implications of legal compliance and governance. Thank you.
Thank you so much, David. And once again, just to emphasize, please do reach out to David, because I'm sure there are many of you who have questions or, just want to share some time to really talk about this, vast space and opportunities of metaverse. It's very difficult to consolidate that in 5 minutes, but at least you got a teaser. And just like David mentioned, we're now going to look into the aspects of regulation that are here that you have to consider when it comes to the metaverse, and also what the role that Web3 can play and what role can Switzerland play in that. So to moderate this fireside chat, we're very happy to welcome Thomas Linder. He's a tax partner at MME with extensive experience in providing tax advice to companies based in Switzerland and abroad. He's also considered a pioneer within tax and legal analysis of decentralized business models, and he was also recognized by WWL as a global leader in blockchain 2021. So please give it up for Thomas Linder and his fireside chat panelists.
Thank you very much for this very nice introduction. I'm just a small tax advisor, but all I know is if something gets big, then usually tax authorities will be interested very soon. And I'm looking forward to kind of the first metaverse tax that will be introduced and which jurisdiction it will be. But today the topic will not be tax. It's regulations and the questions why smart regulation matters. And my guest is Bertrand Perez. He was involved in software and telecom since around 30 years, became interested in blockchain around 2014 while working for PayPal, a payment provider. Then you've been a COO for Libra or Diem afterwards. And now you're at Web3 Foundation, and with the mission to deliver an internet where users control their own data, identity, and destiny. And welcome, and thanks for being here. And just let's start with a personal question. So it seems that moving from PayPal to Libra to Web3, you kind of had your own path of decentralization in your career, right?
Yeah, that's right. I decentralized myself into the metaverse, and actually, it's my avatar sitting here. So yeah, it's been an evolution, but I think it's been a natural evolution as an engineer and as a technologist. As you said, I discovered blockchain through Bitcoin in 2013, and really after digging into blockchain technology, I was really amazed by the power of the technology. And what it could bring, and especially at that time I was working for one of the leaders of payments on the internet. Naturally, there were tons of adaptations or tons of usages internally to PayPal itself. So I started to evangelize internally so that the firm could start to look of what could be the good usages and what that technology could bring as added value internally. And as a personal goal, I just thought that my next professional move should be in the space. I was
lucky enough to have that proposal in end of 2018 when the folks from Libra contacted me to join the project, and I think it took me a fraction of a second to tell them yes. So, and now at the foundation as being one of the main Web 3.0 foundations and helping the Polkadot technology to thrive and grow. It's really the continuation of that journey in the same world that I'm kind of really enjoying a lot.
Let's start with the metaverse. So, what is it for you, or what shall it be, maybe?
I think David has done a very good job at describing what is the metaverse, which is basically this immersive environment, immersive digital environment that you can use for leisure, for some work applications where we see that we are all moving forward. And I would say that it's not that new. I mean, I would say we're living in the metaverse a lot of our time since COVID. Every time we're on a Zoom call or every time we're on a virtual call, we're in a metaverse and we are projecting an avatar of ourselves in that metaverse, which is our video. So it's an extension of that for me. It's basically the new version of the internet where the limits between the physical and the digital are blurring and that you have much more interactions. David described that through specific devices and interfaces and so on. There's really that frontier between the physical and digital world disappears. And it's really exciting. It brings a lot of opportunities, this new version of the internet. But as you know, and as we will speak, it brings also a lot of challenges. Like any major innovation, you have lots of opportunities, but also some challenges, whether it's regulation or other topics, IP control, etc., that needs to be addressed in a way. But it's a major opportunity for humans in their professional life, but also in their personal life, provided it's done the proper way. And I think that's something that we all need to be cautious of.
I don't know whether you know the 7 rules of the metaverse. I found this by Tony Parisi. And he said, there is only one metaverse. It is for everyone. Nobody controls the metaverse. The metaverse is open, is hardware independent, it's a network, and it's the internet. So kind of the 7 rules. Would you agree? Or
Yeah. As I said, I would say those are the 7 idealistic rules in a perfect world. I tend to agree with that North Star and idealistic vision. Of course, there's one metaverse. Yes, that would be ideal in some sense, because that would mean that there's the ability for users to interoperate inside the metaverse without having to have different identities, because the metaverse is completely an heterogeneous environment. So if you want to interact with a given service in a given metaverse and another one in another one, then it complexifies users. So ideally, there's only one, but that also can bring additional questions about hegemony and these kind of problems. And it is the internet. Yes, it's the evolution of the internet. And as this internet is evolving, we are also seeing that the interfaces to that new internet are evolving. So it's like the shift between computers, laptops to mobile phones. Now we see that the next shift is going to be from mobile phones to VR and the AR devices, whether it's glasses or lenses or any other kind of devices that we see there that will be needed, because you will be immersed in the real world and the digital world most of your time. So you will need a device that you are able to use easily to navigate between those two worlds. So that's also the evolution of how we access that metaverse is also an important question. There's only one metaverse. I would tend to say it scares me a bit, honestly. I'm an idealist, but not to that extent, because of course we should not be naive. If there's one metaverse, who is going to control it? What is going to be the governance and so on?
Nobody.
Yeah, but I don't. Yeah, again, idealistically, yes.
And do you see the metaverse rather as a digital world, or is it more like augmented reality with digital aspects, etc.?
Yeah, it's the combination of the two. It's really the digital one where basically anything is possible. So, like David was saying, you're next to James Bond in the next movie, and all kind of we see all kind of usages in the entertainment world, but there are also tons of applications in a more professional world. And also the augmented reality part is also going to be a big one, and the two are providing different services, and they are complementing each other, and we will be switching between the two of them.
Coming back to the main topic, so why smart regulation matters. So do we really need regulation of the metaverse, or what do we need?
I mean, if you ask that to cyberpunks, they will tell you no. But again, this is an idealistic position. In our world, it's hard to live in the Wild West without regulation, because we all know that we need to have some levels of control. So I would say, but why it needs to, if regulation is needed, then it needs to be smart. It needs to be smart in the sense that it needs to protect people on different kind of threats that could happen. For example, just one, how you protect kids from access to content that they are not supposed to access, or to violence and all the kind of, I would say, bad usages that you can see on the metaverse. But also, how do you protect kids from spending 10 hours a day in a virtual reality, so spending more time in the metaverse than in the real world? What are the effects on the adults that they will be becoming afterwards? So I think right now, everyone is aware that regulation is needed in the front of financial regulation, IP, access to adult content and these kind of things. But I would say broader than that, the question is, what is going to be the impact on humanity, and especially with kids that grow up in a virtual environment and just spend maybe 2 or 3 hours in the real world per day versus the rest immersed in those worlds? What is the impact for humanity from that perspective? And I think these are questions, there are philosophical and also regulatory questions that needs to be addressed. So that's one. Secondly, it's also, I mean, from my background, regulation by enforcement is not the way this should be done. So because we are only scratching the surface of the capabilities. So you need to let innovation appear and thrive, and then see potentially which are the risks and try to mitigate them. And some parts of this world are good at that. Some others are really bad at it. And I would say a good example is Switzerland, where, for example, if we compare that to crypto and blockchain, Switzerland was the first country in the world to have a clear regulation for crypto assets, with clear and clearly defined and well-defined frameworks for the different kind of crypto assets. So at least they were providing guidance, they were providing a framework, and then companies were able to develop their services, which is not the case in other parts. So I think this pragmatic approach that Switzerland has taken with the blockchain space should be the same with the metaverse one, basically being there to try to see and have a pragmatic view, no religious view on what the regulation should be, and not losing sight that regulation is there to protect people and nothing else, and trying to do that in the best possible way. But yes, to your question, smart regulation, so the two words are important, is needed.
Yeah, for me as a lawyer, it's kind of, law has always two sides, right? On one hand, law is just the basic of our relationships, so that I'm a natural person, there are corporations, then we can have contracts, etc. So that's law. And I think, especially here in Metaverse and all the other digital topics, mostly needed is actually a digitalization of the law, so that all these relationships can also be represented, so that I can legally binding, sign contracts in the metaverse by my avatar or whatever I want to do. And I think this is needed, so that we have a basic kind of just a basic ground where we can build up, and that's not yet there. I mean, even digital assets are not No, I don't start there. But and then on the other hand, regulation is more than the government looking at you and telling you what not to do. You're not allowed to do that. You're not allowed to do that. If you do it like that, you need to follow these rules. And that should, as you said, this should only be to protect people, to protect weak people. And in a lot of circumstances, I don't need protections, but maybe someone else. And I think that's the kind of the smart way not to over-regulate people that don't need to be protected.
Absolutely.
And what do you think can the Web3 play all in this, and with your background at the foundation and Polkadot as a system?
Yeah, so Polkadot is a layer 0 protocol, and we are the goal of the protocol is to allow projects to develop their own blockchains. So by essence, Polkadot is agnostic about what the kind of services or blockchains that are developed on top of it. The goal is to provide the best platform and the best development tools for those different projects, whether it's DeFi, whether it's NFTs or Metaverse or others. So provide as much as freedom and tools to be able to develop on that. And obviously, Metaverse is one of the potential applications of the technology. The good thing is that natively within the protocol, we have a set of tools for interoperability, which is going to be key in Metaverse, because again, back to the idealistic vision of one Metaverse where everyone is and there's no other Metaverse, you're going to have different ones, and you're going to find ways for those Metaverse to be able to interoperate, for users to be able to navigate between them. And natively, Polkadot is providing protocols and tools for that interoperability to happen. So it's one of the main areas that we feel Polkadot is providing solutions, and we are starting to see some partners, specifically in the Metaverse place, who are starting to build their own metaverses on top of Polkadot, and it seems that they are getting some nice results and nice traction. So we're really excited by that.
Cool. Maybe to finish, a short summary to the question why smart regulation matters and how shall it look like. As said, so for me, it's actually we should provide legal certainty in order to allow innovation. And then we need to protect weak persons or persons that need to be protected.
Absolutely.
Thank you very much. It was a pleasure.
Thank you, Thomas. Thank you very much.
Thank you very much, Thomas. Thank you very much, Bitenc. And for that, we do a segue from metaverse and regulations, and we started looking at powering the new data economy, where our next speaker will delve around the problem of the current data economy and the potential barriers for SMEs to monetize their data and how this can be overcome. Mathias de Vries has been working since a very young age as a software developer in many different industries, and at some point along his career, he got hooked onto crypto and came to co-found at AllianceBlock. Now, this is an open source set of financial building blocks that make it easy for anyone who wants to leverage the opportunities of DeFi. And he also founded this together with Rashid Ayaya, who we heard earlier in a panel. So let's give a warm welcome to Mathias de Vries.
Thank you, Sabine. Good day, everyone. My name is Mathias de Vries, co-founder and CTO of AllianceBlock. And today I'm going to talk about something else, data. The current state of the data economy. I want to speak about how we can power a revolution of the data economy. What's the current state of the data economy? It's a $3 trillion industry, but the data, who owns the data has the power. And a vast amount of this data, it's owned by a select few of very large corporations. And if we combine our knowledge and capabilities, we could share in this power. And we can do this if we focus on these three things. Collaboration, where we can work together to enhance the quality of the data sets and its metadata. through standardization for an easier way of integrating this data, and through a transparent rewarding model for those that contribute to the quality of this data. And for if we want to have a good adoption for this new data economy, we need to accommodate enterprises. And enterprises, they need a lot of things, but 3 of these things are really, really important: reliable, fast, scalable, powerful infrastructure, especially also when working with other enterprises together. They need standardization for easy integration of these data sets, and they need inherent GDPR compliance at its core of this ecosystem. For the current status of the landscape, of the data landscape, is very fractured. Data sets are everywhere, thus they are nowhere. Data sets in all kinds of formats, so it's really a pain to integrate this perfectly in existing systems. You can have one system where you focus on a single data set, and then when you want to extend this system, you need to either rewrite a lot of your code again in another way to accommodate this new data set, or converse this data set completely to accommodate your system. So longer time to market, a lot of costs, inefficient process, basically. So for SMEs, in order to deal with all these things, if they want to monetize their data, it's a very high barrier. And if we look at SMEs, every organization nowadays, one way or another, consciously, unconsciously, is generating data. And no matter how obscure this data is, there is always somebody out there that can use this data. But it's very hard to monetize this data as an SME, because if you want to have it standardized, if you want to have it compliant, it's a lot of cost involved. And this is why there is a need for a revolutionary marketplace where this data is easily uploadable, whether it's programmatically or manually, regardless of what kind of file type it is, and so that it will be automatically converted into a generalized format, and where the metadata is automatically extracted based on the context of the data itself. Then for consumers, it's very important that this data that can be found on this marketplace is predictable, so that it can be easily integrated into a system, as easy as the next one and the next one and the next one. So for contributors, it's very important that if they contribute to the enhancement of the quality of these data sets, that they are rewarded fairly and that this is recorded transparently. So I propose that we do this in a decentralized way, that all the action of the contributors are recorded on-chain, so that they are guaranteed a fair amount of the revenue that is generated by consuming these data sets. And if we speak about contributors, what does it actually mean? So let's focus on metadata for a moment, because metadata is still an often neglected area in this field. And the value we can see here, if you take a single data point in a data set, the data point is called points. We know that from the context that it's a number, sometimes this can be empty, but what does points really mean? We cannot see this just from this metadata. So if we have a community of contributors that are able, from the context of the data itself, from where this data was sourced from, can deeply describe this data, like we see here with categories, tags, descriptions, we can develop a system that can go through all this metadata of all these obscured, now available data sets that were previously siloed and locked away in surface for nobody to access. We can find connections between data sets that we've never seen before, thus driving innovations for use cases that we don't know that exist today. And to wrap up, if we go from siloed data sets, we enhance its metadata, we can come to a system where we can drive innovation And with AllianceBlock today, we have that with the data tunnel, where we have this revolutionary marketplace, which is based on reputation, on-chain, a reward distribution model, royalty-based, on-chain, which allows contributors to be fairly rewarded for their work and allows this to happen to kickstart the new data economy. Thank you.
Thank you so much for that. And with that, we're now going to look at another emerging markets. We're going to look at Web3 mass adoption and how it's really leapfrogging on the African continent. And also bearing in mind that demographically, the African continent is the youngest continent and they're very adaptable to technology. And CVVC has invested in 12 African startups that possess more utility in their applications than speculations. So we have an eminent panel who are going to dive more into this, and we also have an eminent moderator, and that's the managing director of CVVC Africa, Gideon Greaves. So please give a round up for Gideon and his panelists.
Alrighty, guys. So today we're talking about the new Bitcoin, in my opinion, Africa. So I see a lot of moderators today have been introducing the panel, but we've got a really, really interesting panel today. So I thought I'd give you all each 1 minute to introduce yourself. Sandi, you go first.
1 minute. Introduce the project or?
The project, yeah.
So I'm Sandi Bitenc, I'm the CEO of 3R. We are developing a project that can bring millions of new users on the blockchain just because we can give them the internet connectivity. So we have a technology that can bring internet over air on distances of up to 50 kilometers, and it's true broadband. It goes up to 1 gigabit per second.
Fantastic. Yosuke?
So hi, everyone. My name is Yosuke Yoshida. I'm the co-CEO of Emurgo Africa. Emurgo is one of the founding entities of Cardano, which is the first layer blockchain. Since I'm responsible for the African market, we invest in African projects, we accelerate them, and we want to expand the Cardano ecosystem.
Okay, good afternoon, everyone. My name is Obanam Dichukwebuka. I'm the co-founder and CEO of House Africa. So at House Africa, we are digitizing property cities and the property titles using blockchain technology and map, making it easy for home buyers to easily access and verify property details.
Thanks, Uber. So we're going all across the continent to Egypt now, Mohammed.
Yes, thank you. Hello, everyone. I'm Mohammed Abdo, founder and CEO of Pravica. And Pravica is a Web3 messaging and blockchain-enabled conversation. So actually, we are helping people, enterprises, to secure the messaging layer when it comes to exchanging critical information. Thank you.
Thanks, Mohammed. So we all know that Africa, as it was mentioned before, is really teaching the rest of the world about the true use cases of blockchain. When you look at the developed markets, there's a lot of focus on the speculative assets. House Africa is a fantastic example of a real strong startup that's using blockchain. That's a relevant use case for Africa. Can you tell us a bit more about your specific use case, and then tell us more about use cases in Africa and how they differ to the developed markets?
Okay, one of the difference between the African and the developed market is in Africa, we look at the immediate use cases. For example, looking at from the housing side, where all the property titles are still on paper, and it's very difficult to verify who owns the properties. And we, according to the PwC report, debt assets in Nigeria alone valued about $900 billion. And imagine unlocking these debt capitals by putting all these titles on NFTs and blockchain and make it easy for even the financial institutions to access. We'll be unlocking $900 billion, adding it to the GDP of Nigeria, which is about $440 billion now. We're talking about having $1.4 trillion as a growth in the GDP. So bringing blockchain into the African market is going to enhance the African market. And again, not just in the real estate sector, in the financial sector, we talk about the remittance, where the value of the remittance in Nigeria currently now is $20 billion. Families and friends outside Nigeria send over $20 billion every year to Nigeria. Using blockchain and cryptocurrency to increase the speed of sending these remittances is going to also increase the number of money being sent to families at home in Africa.
Thanks, Suba. Yosuke, you've got a lot of experience now in Africa. I think Emurgo has invested now in 22 projects, is that correct?
I think we'll be able to invest up to 30 within this year, right? Yeah.
What have you been seeing? What's been different in Africa? Tell us about the use cases.
Okay. So actually, he raised a very good point. Like, so we think that in those emerging markets, blockchain can solve the real problems. Like in his case, actually, I like the case in the real estate business. Like my friend, my British friend, he owns this certain property in a certain country in Africa. I won't say the country name, but he owns this place. But he's not really sure whether he really owns it until he's able to sell it and receive the cash in his bank account. Until he sees the bank account, the figures there, he's still not very sure about whether he really owns it. Someone might come up to you, oh, I also own it. That kind of things are happening. And that's not going to happen in Japan, in Tokyo. It's never going to happen. So that's the kind of things that the real problems, real issues that we see in the emerging market, and where we can bring in blockchain and we can solve them.
Talking about different use cases in Africa, we know that almost 75% of the population is actually offline. Bringing this population online, what does that do for the market in Africa, Sandi?
Well, it expands it, right? The markets are actually the people that are using it. So, and when we're talking about blockchain in particular, there is no blockchain without the internet. So every user actually needs to have internet access. But it's not only about that, right? So it's not only about blockchain. It's whatever you do with businesses right now. I don't know. I really don't know any business that wouldn't benefit from having access to the internet, right? And again, it's not only about businesses. It's also about governments. It's about education. It's about healthcare. It's about personal relationships. Everything is bound to the internet.
So we're seeing a lot of really interesting statistics in Africa, one of them being the average age of the continent, right?
Yeah.
And I don't know if the audience knows this, but the average age of people in Africa is 19. The second youngest continent is South America with an average age of 31. And that really speaks to the leapfrogging potential in Africa. Mohammed, can you tell us a little bit more about how African startups can leapfrog and take advantage of this Web3 technology?
Yeah, thank you for that. I think we have great advantages in Africa. One of them, the great talents. Like we have a great mindset, we have great talents, great developers, which is the real assets when it comes to building a successful startup or a successful company, especially the tech companies. So we have the real asset, which is the developers and the talents that they can take the technology to the next level and keep developing and delivering a lot of products. The second thing I believe, which is the cost efficiency. I mean, when you start building a team to develop any idea, think about the differences in salary and all these things. So the cost efficient to build startup in Africa is one of the great advantages. So I think 30% less than any other places when it comes to salaries and all these things. So the cost efficiency and the talent acquisition that you can find easily, those are the most important things when it comes to building startups in Africa.
Thanks, Mohammed. I also want to take this opportunity to congratulate you on the Pravica Club launch yesterday. If any of you in the audience are using centralized communication platforms like Telegram and Discord, you should be using the decentralized version, which is Pravica Club. So well done on that.
Thank you. Thank you so much.
So why should investors be looking into Africa? Of course, at CVVC, we know why. What's been interesting for us is that we see there's limited access to capital in that early stage pre-seed, seed investment channel. We're seeing most of the capital flowing from the developed markets coming into Africa is flowing predominantly into those validated growth rounds, which is why it's been really interesting for us from the early stage projects that we've invested in, to see how long these founders have bootstrapped for. Uber, you went through our incubation program, in fact, and you already had revenue, you already had users, you had 9 employees, in fact. Tell us a little bit more about what it's like for investors to come into Africa and why it's attractive.
Okay, yeah. Investing in Africa is really, for me, there's this word I want to use. It's phenomenal because this X amount return coming from the investing in Africa is usually huge. For example, if you look at what has gone over the years, the first unicorn in Africa, it took 17 years, and the latest unicorn took on just 2 years.
Yeah, so you see that 2 unicorns, just went from 0 to $1 billion in 2 years.
Exactly. From first year, the second year became $1 billion company. So you see that the growth is exponential. And we too, I could remember last year when we were in CVC, we were just 2, me and my co-founder, and we joined CVVC. And today, within 10 months, today we are 15 team members, and we have grown. We have 200,000 digital properties on our platform, and we'll also have a state government that we are already working, digitizing a full state and city. So you see that investing in startups in Africa has a huge potential and returns heavily. So that's my own point of view.
Yosuke, you've launched in Africa recently. Why were you looking at the continent? What was interesting for you?
Yeah, I think you've explained pretty good, but if I have to choose one word, it would be leapfrog, actually. So let's give an example from other countries. Like in China, the payment system, Alipay, went all over the country in like 2-3 years. That's because they had issues there. They had this counterfeit banknote problem. The credit card wasn't really popular. That's why it spread all over the continent, billion people in China in like 2-3 years. And like in Japan, it's not very popular, to be honest. Like 30% of the people are using this digital payment system because they don't have issues. There's no fake note problems. Credit card, you can use it all over the place. And they just leapfrog. So that kind of things will be happening all over in the continent. So that's what we believe, and that's why we want to bring the best technology, the latest technology into the emerging market.
And Emurgo isn't one of the only big investors that have launched into Africa, or at least started investing into startups on the continent. We've seen the likes of Sequoia Capital, Andreessen Horowitz, SoftBank, Tiger Global all enter the market for the first time, and that's brought an influx of capital into the African continent. There's a great statistic of how long it took $1 billion to be invested into Africa. Last year, it took 8 months to hit that $1 billion mark. In 2020, it took 11 months. And this year, it only took 7 weeks. So the market is growing really, really quickly, and investors are paying attention to that. Sandi, of course, as we mentioned earlier, a lot of Africans are now going to be coming online and participating in the market. What does that mean? Surely that also gives the opportunity for the unbanked to be banked, for digital identity to start taking place.
Yeah, for sure. And there is a huge need, just to get to the previous point maybe, in Africa, because it's having a perfect product that nobody wants or needs, it doesn't help you, right? Or just having a product that just solves a bit of a problem. And blockchain solves actually a huge problem in Africa, and that's it is connected to banking. In a sense, Bitcoin was created to solve the issues, of the underprivileged, to give them the financial tools. There are two really issues that I see in banking, the unbanked kind of. The one is that the majority of the unbanked is actually also unconnected. And I talked before that if you want to use blockchain, you need to have the internet connection. So banking somebody with the blockchain requires you to have an internet connection. So there's just no banking the unbanked without connecting them first. And the second one is that right now, there are really no really good solutions in onboarding people to crypto, even if they have a internet connection, without them actually needing to have a credit card or a bank account to be able to transfer the money to an exchange and then buy it there, right? And that's kind of a paradox in itself. So if you need that to get into crypto, a credit card or a bank account, then you're already banked. So then it's impossible kind of to bank the unbanked with crypto, right? So those are the two things that we see that need to be solved, and this is also what we're trying to solve. So the internet connectivity, we in a sense is what we are there for, but also the platform. We're streamlining the onboarding process, and we are working on our side and also with some partners on a solution that can bring cash to crypto onboarding. And first of all, we have our offices always on the ground. We need to have them just because we are on licensed ISP, but it's also not enough. So we need to spread it. We need to decentralize also in that sense. So what is happening right now in Africa is that there are peer-to-peer cash to crypto onboarding platforms popping up. And what this means is that there are people all around, like you and me, that are part of that and kind of vouched for. And you can walk to them and give them cash, they'll give you crypto, or if you want to cash out, you send them crypto to their wallet, they'll give you cash. And I think those are really the main issues that need to be solved if we really want to bank the unbanked.
And what challenges do you think that we're seeing, Mohammed, for entrepreneurs and founders in the Web3 space, specifically in Africa? Some that we can think of, right, is capital, of course, regulation. What else are we seeing?
So I believe that you need to find the real problem to solve, and not just going with the buzzwords or something that coming as a pulse and then go away. You need to find the real problem, and I believe that in Africa you have many of them to solve. Once you validated the idea and validated that you can solve this problem using the power behind blockchain technology, then start building the team and then going to raise fund. And there is a great problem here in terms of raising funds in Africa. So if it is hard for any startup to raise fund, it's 10x harder for any blockchain startup to raise. And especially when it comes to the Africa region, you need to find the Web3 or related VCs where they can understand exactly what's the value proposition behind your project. Because discussing with like normal VCs or whatever it is, it's very hard to give them this kind of knowledge and awareness and trying to convince them about the technology. So there's not too much Web3 VCs in the Africa region. We need to see more and more, because we have the great projects. And personally, I know many projects, they shut down because there is no fund in Africa.
I think every jurisdiction or location in Africa has got its different challenges. I know in Egypt, one of them is regulation. And we can't avoid that topic, right? Specifically in Africa. What's it like as a founder in Egypt, building a Web3 startup with very, very tight regulation?
Yeah, we need to differentiate here between Web3 and crypto. So if you are building something related to the DeFi, so it is purely crypto project, according to the protocol and tokens and all these things. And for sure, you need like countries, when it comes to launching the projects, you need countries that they have the regulations, or what we call it crypto-friendly country to issue your token or whatever it is. But in the Web3, it's completely different. Web3, it's just like a methodology of how you are changing the way dealing with the data itself by using blockchain technology. And it's open. I think there's no one can regulate a technology itself, but the regulation here comes for the way of how we are dealing with this technology. So in Web3, as long as you are building something which is a way of issuing a token or something like this, no one can tell you stop or can shut down your company. But when it comes to issuing a tokens or something like this, you need to find the right place. And I see from inside the MENA region, like in the GCC area and in Africa, there is a demand right now, and there is a move toward regulating the virtual assets. We see in Dubai, and I think 2 weeks ago, I heard about a new initiative from Saudi Arabia to start exploring the virtual assets and how to regulate it. So it begins like very small and then spread time by time.
One of the interesting things that I've seen since we've launched CBDC in Africa is the quality of the entrepreneurs and the founders. And it's a stat that I actually mentioned on stage last year, but it's something that I really, really found interesting. And it's a report that was written by the African Development Bank, which tells us that 22% of working age Africans own their own business. So that's 1 in 5 Africans almost that own their own business. Your business partner, Uber, actually told me that 60% of Africans are under the age of 25, which is incredible.
Yeah.
And what's interesting about the founders that we've invested in is that they really are so emotionally attached to their projects, more so than I think other founders in more developed markets, because they have to be. If their project fails,
they go back to the village.
They're a bit screwed, right? When Switzerland's a bit different. There's other opportunities. So you've got a set of founders and entrepreneurs that can really persevere and persist and really, really pivot if the opportunity is there or if they need to. But there are some other challenges like developers. Uber, what are you seeing with developers and finding talent for House Africa?
Okay, on that angle, how we usually solve that problem is we being developers ourselves, because we started by building it ourselves before we started bringing in people that can help us. So they now build on the guidelines of that, on the foundation that we have built. So that way, it makes it easier to direct and bring in new plans on how this can be done. When you as a founder don't have the experience, that is where the problem comes in, because you need to be able to tell what next and where next to go. And again, one thing about startups in Africa is, as you are building, there are a lot of feedbacks and things can keep changing. You can even pivot your entire business model. And so you need those speed. You don't need to, you need that speed, the agile, to keep moving. And you, that is in the front, should be able to understand so that other people can easily follow you. That way, we're able to keep the business moving. So even if, as we are here in Switzerland, the business is moving and we are not even worried whether things are going wrong.
Yosuke, I know Emurgo is very passionate about educating developers in Africa. What have you been doing from that perspective?
Thank you for the question. So, yes, we see like brilliant people, very smart people in Africa. The wealthy people get the highest education, and like they go overseas in Harvard, Yale, Cambridge, whatever. But like, not everyone in Africa would be able to get that kind of education. And what we are doing, it's part of Emurgo, and actually the founder of Cardano, which is we work for Cardano. So Cardano's founder started this project called PLP, which is an NGO, which is educating 1 million developers for free from his pocket. So We started this program with Nairobi University, which is one of the best universities in the continent. We are spreading to 10 countries by next year. Yes, that's how we want to bring, contribute to the continent. And eventually, we, of course, want to expand the Cardano ecosystem. But that's something what we're doing.
Sandi, so you're an entrepreneur that's focused on trying to solve a problem in Africa, but you're not based in Africa. And we've seen that a lot. We've seen a lot of very talented entrepreneurs that are outside the country, or the continent rather, that are seeing an opportunity to solve problems there. What's it like being an entrepreneur that doesn't have a boot on the ground, but is very familiar with the market?
Well, that's I think right now entrepreneurship isn't really bound locally anymore, right? The majority of projects, if we look into crypto space, right, we're talking about that, they're global projects, so it doesn't really matter so much where you're located. But I love Africa. I love to travel, and Africa is actually my prime destination. This wasn't really why we started building there. It's more or less let's say, product market fit. So what we are actually doing is a really, really good solution for what hasn't been, nobody has been able to solve that. Just because broadband in Africa is below 1% penetration rate, and it's like nothing, right? And many have tried, and you cannot do it with normal solutions. So you need to do it over air in a sense. But there is always a problem with range and so on. So this is where we found the solution, and this is why we ended up in Africa. But it's like working any other job most of the time. So I don't see any really specifics there from that point. There are differences if you're speaking, especially working in Africa and maybe looking at it from a perspective from let's say from a European. And there are huge cultural differences, and I think that's a big barrier for entering from outside capital into Africa, just because they don't understand it. If you just try and go into Africa and build something there, you'll probably fail, just because you don't know the culture. It's really so different. So from our side, we always try to partner up with locals, as bigger companies, just to help us with regulation, with understanding the market. And I think this is one of the primary things that if you want to go into Africa from the outside, you need to understand that.
I think that's a great point. I think CBVC, before we launched the initiative in Africa, saw that as well, which is why we have boots on the ground and have now announced a partnership with Emurgo to really grow the ecosystem out. The first thing we'll be doing together is the event in Nairobi on the 28th of October, which we're very excited about. So working together in the continent is really, really important to build the ecosystem, to have boots on the ground. As you said, it is a difficult market culturally to get into as well. We can't have a blockchain conversation without doing some predictions, right? So Mohammed, we'll start with you, ending at Sandi. Tell me some predictions for the African market, specifically focused on blockchain and Web3.
So I believe in the next 2 to 3 years, we will see a significant increase in number of blockchain startups in Africa. And I believe that every single startup coming in the very near future will solve one of the great problems that we facing in Africa. So I believe that it's an open space for everyone who wants to invest in Africa to join this journey from the beginning.
Uber, over to you.
Yeah, in the next, of course, I believe in the next few years, let's say 4 or 5 years, there will be a huge cash flow from the foreign investment to Africa, although it has already started, even at the where the Westerners are having a low investment turnouts, there's still a massive increase investing in Africa. For example, the first quarter of this year, Africa did almost $2 billion in investment. So, and this is increasing rapidly. And I see Africa coming very close to the rest of the world in terms of investment.
Yosuke, I know Emurgo is very bullish on Africa. What are your thoughts for the future?
We see Africa, the continent, as a place where the blockchain can solve the real problems and show the world what blockchain can do. So not African following other countries. African is where things can really start. Okay, there's a real use case that has been created in Africa, and which will be exported to the rest of the world. That's the kind of place that we see Africa, and that's why we, as Emurgo, as Cardano, we are focusing on the market. Yeah.
Sandi, I am African, as a proud South African, and you've been to more African countries than me. What is your prediction?
Well, I am bullish long term. Maybe short terms, I don't think we'll see like major shifts in the next 3 to 5 years. But I do see Africa actually being the biggest and fastest adopter of blockchain technology, just because there's this sheer need for it, right? So they don't have the old infrastructure, the old services in place. And yeah, it is like leapfrogging over a whole generation of technology. So this is why I'm so bullish. But there are still a lot of things that need to be solved, and it is about regulation, it is about corruption. The capital is starting to flow in, and I think it will continue and you know, even pick up. And with time, that will bring Africa. I think, you know, they have the option to actually come out of this on top. But there still is also a big lack of underlying infrastructure. So you do want to include everyone in this. And that also means connecting a lot of people still, right? You cannot build something for everyone if they can really not use it. That's the thing. So there's a lot of steps that need to happen before we see a general adoption of the blockchain in Africa.
Cool. Well, thank you very much, guys. Some great conversation and comments made by the panel today. If anyone has questions on Africa or is interested, you know who to speak to. Thank you.
Thank you. Thank you.
Thank you so much to the panel, and really the best of luck going forward, because the African continent is definitely on a rise when it comes to mass adoption. So with that, it's time for us to take nearly a 1 hour break. We'll be resumed here on stage at 6. Then we'll talk about crypto assets, Web3 security, investing tokenized commodities, and also concluding with unicorns in the making. So all of you are here, please seize this last opportunity, at least for today, to look at the NFT gallery, Metaverse, network and mingle, and all of our online viewers also seize the opportunity to network and mingle, but digitally, and using the Brella app to reach out, and see you all at 6 p.m. Thank you. a warm welcome back to our live audience here at the Theatre Casino, and of course also to our online viewers joining us from all over the world. We've had amazing 2 days so far. We've now come to the last block of the second day of the CV Summit. For those of you who might be joining, at this stage, my name is Sabine van Gafke, and I've been the moderator facilitating us through these 2 days. Now, we've come to the last block, and this block, we're going to look more into crypto assets, we're going to look at Web3 security, we're going to look at investing in tokenized commodities, and we're going to sort of round up at looking at the making of unicorns. But we start off with kicking this last session with a fireside chat on diversified crypto assets exposure through funds of funds. And to moderate this fireside chat, we have Philippe Negali, who is the co-founder and CEO of Gen2. He's also a business leader, an active investor with a strong entrepreneurial spirit, and avid experience in investments, in merchant banking, general management, and corporate governance. So please give it up for Philippe and his two panelists.
So, welcome. Wonderful to be back at this summit. I hope you all enjoyed it. How was it for you guys? All right, yeah, so many new faces and wonderful talks here. Amazing 2 days. So we're entering the last hour of the event, and so I'm here with David and David. They come in packages. They're both unique experts in the field of asset management and venture capital. And we certainly are here to discuss a bit more about that. So maybe, David, you want to introduce yourself quickly to the audience?
Sure. Thanks for having me. My name is David Frisch. I'm a partner at Crossbow Partners. We sit just here in Zug, in Bar, actually. We are specialized in multi-manager hedge fund solution. And we're quite happy that now they are hedge fund investing in crypto since a few years now. So we started to manage some products together with CBDC, which focus exclusively on digital asset dedicated hedge funds.
Wonderful, thank you so much. So David Long, you want to say a few words?
Yes, thank you. It's a pleasure to be here. So I think as everybody sees up there on the screen, I'm David Long. I'm co-head of investments at CBVC. I think just about everybody here knows CBVC, and as we are a venture capital, I would hope so. As we're a venture capital firm first, we do recognize that there's an incredible opportunity in digital assets, and that's why we did this co-launch product with Crossbow.
Sure. So maybe first, top down, like we've seen a lot of volatility in the recent months. I mean, crypto has it. We must say that there is volatility in the market. And, but on the other side, we also see that there is a lot of new developments there, a lot of partners coming in, big parties are coming to the stage. We see a lot of deals happening. I mean, from BlackRock over to 21 shares, a Swiss unicorn, double unicorn now. So we see all of that. And how does that fit in with the volatility, and how does that fit in with your thinking of the markets here?
So if I can start, I think that it's still very early days. And when we look at the amount of adoption, and this has been a common theme that we've seen, our CBVC CIO, Olaf Hannemann, he talked about this in the very beginning of his keynote speech yesterday. We're seeing that the large banks, as you mentioned, the BlackRocks of the world, also Goldman Sachs offering Bitcoin-backed loans. You know, the large banks are coming to the space, and we believe that that will push the adoption further. Also, if you look at the top 10 companies listed on the stock market today, all of by market cap, all of them are utilizing blockchain in some capacity, or they're exploring on how they can add value. Why do I bring that up? Because that's not directly related to digital assets investing in that or using fund of funds, but these are the sort of institutions that will drive the adoption further amongst the general public. So as that happens, you start to see more demand getting into the space, and there is definitely plenty of demand within the space for getting into digital assets. We're seeing that there is more products coming out from asset managers. There is more demand. You're seeing that from the headlines in the media. But the general public still does not fully understand where to bucket these digital assets? Is it a commodity? Is it a currency? Is it a tech stock? Now it seems to be a risk on tech stock that they put that into a bucket. So it's been incorrectly hit. But as I mentioned early days, it creates an incredible opportunity for us utilizing a strategy like we've done to get in using hedge fund strategies to benefit from the arbitrage that currently exists.
Sure. So would you say that it's here and now? Is that the time to be? Is that the time to come into these markets for everybody that's not?
I certainly believe that this is absolutely 100% a buying opportunity.
All right. So, David.
Yeah, the nice thing about, obviously, we all know that, but crypto assets, digital assets are very volatile and full of inefficiency. And basically, these are the two criteria that are very favorable to hedge fund strategy. Think about hedge fund 20, 30 years ago, where you had less players, so much more inefficiency in the market. It was a fertile ground for them to generate high returns. So now, crypto-dedicated hedge funds have the same opportunities. So that's why our approach is to go through, first, active management to benefit from this growth in digital assets. So we want to provide a return to investors that take advantage of these huge opportunities among digital assets, but at the same time, with a different risk-return profile, meaning less volatility, less downside to some extent. So, the aim is to have upside volatility and less downside volatility, and also uncorrelated returns. So in a nutshell, it means basically trying to generate alpha and not just to deliver market beta. So because market beta, you can get it from just buying a passive product. We want to provide something for investors who are looking for something maybe less volatile and that provide diversification in the overall portfolio and to the existing maybe digital asset investment. And the two concepts we use to achieve that is basically, as we said, active management and then diversification. And so active management, we achieve that by investing into digital asset hedge funds. So we try to find experts, managers, hedge fund managers that dedicate entirely to digital assets and that have full flexibility in the investment mandate. That means they can be long the market, they can be short the market, they can be fully directional, they can be market neutral, they can have a high cash level in the portfolio depending on market opportunities, or no cash at all, be fully invested. They have full flexibility. And that allows them to generate different return profiles. And then what we do to achieve diversification is that we build portfolios by putting together several of these crypto hedge funds. And ideally, we will try to have in a portfolio of crypto hedge funds that are less correlated to each other to achieve this diversification and provide this uncorrelated return stream. And that is possible because you have hedge funds have so much flexibility that you even have some, for example, market neutral crypto hedge funds that have zero beta, zero correlation to crypto assets. So it's a very attractive proposition in a portfolio.
I like that you went a bit back in time. I mean, all markets needed time to develop, and certainly wanted to, and certainly learn from that. But maybe a bit more on why is it now, and why is that collaboration happening, and what is your guys thinking on that?
Maybe I can take a first
Please,
shot at that. So well, we recognized that at CVVC, and then that was the perfect partnership between the both of us to establish this product, is that we needed a bridge between the old economy and the new. And what I mean by that is the opportunity for blockchain is here, but as a venture capital firm, we're investing in private companies that take, at an early stage, that take quite a long time to develop. And this is an opportunity for the investor to get into something that is non-correlated to the other markets, the digital asset markets, but also leverage, so you're reducing your exposure to going long in any certain currency, or you're going long in any ETF or mutual fund that is backed by currencies, and you also maintain your liquidity.
Sure. Now, with the correlation, we have to be a bit careful, right? I think these assets were a lot less correlated to the markets than they have behaved in the last couple weeks and months. So tell us a bit more, maybe also from your perspective, how you handle that and how you generate alpha out of that. Because finally, it's certainly for traditional investors important to find their ways in through funds, certificates, and all other sorts. But they also want to have that extra alpha and that extra edge.
Exactly. So, I mean, obviously, I mean, if we look at our portfolio, we have some position in hedge fund that are long bias directional in digital assets. So obviously, these investments have suffered during this market downturn. There is no question about it. So these funds they don't use leverage, but because of the nature of the market, they're quite aggressive in the return profile. So some of them had fantastic returns before this year, sorry. They outperformed like long-only investment, but obviously they're suffering as well this year. And that's why to mitigate this volatility, we need to diversify. We cannot have, for example, a portfolio of only highly directional position. So we'll take some less directional and arbitrage, relative value, or market neutral strategy to kind of mitigate that. And that, at the end of the day, help to smooth the downside and generate some alpha in comparison to the market.
Do you think it needs the whole range of products for the market also to find its relevance and to find the mass adoption? Yeah. Or do you think it's just diversification for now?
So it depends on the investor appetite. Some investors want to have something very directional, some pretty aggressive. So kind of a multi-strat diversified portfolio could make it because there is still definitely a kind of directional component to it. And we have some other investors who say, no, you know, I don't want to have something too directional. I prefer something pretty steady. So that's why together with CVVC, we launched a second product, which is dedicated to non-directional or market neutral strategy. And obviously this investment in a bull market will never deliver a kind of a triple-digit return, but in a down market, it can be flat or even positive. So that's the whole difference. And then investors have to think, what do I want in my portfolio? What type of diversification do I want to have? And with this type of products, we can offer a kind of range of risk-return profiles.
David, so is that also the way you see that collaboration? Is that the alpha that you're seeing right now?
Yes, it shortens the journey for the investor, and they don't have to go through those negative periods that we believe we're quite optimistic and we believe very strongly in digital assets and where they're going, but the investor may not have the appetite to hang on in the down markets such as what we're in right now. Whereas these strategies are proven that they are holding up very nicely in these market times.
So the products you launched, 2 of them so far, correct?
Yeah.
So how do you promote the 2 products? What are the main specifics of the 2?
So the first one, which is more like multi-strategy, it definitely wants to capture part of the upside of the digital asset space, but obviously there will be some downside. But as with traditional hedge fund, you might say a general goal would be you want to capture 2/3 of the upside and only 1/3 of the downside. And if you do that in market downturns, it's a lot of alpha actually, and it smooths your returns. And an investor might choose to have only that as a kind of digital asset investment, or he might have some long-only investment in his portfolio of digital assets and mitigate that exposure with something like this, which is less directional. And the second one, as we said, it has no beta to digital assets. So it's really kind of market neutral and a steady return stream.
What are the main interests? What are the main investors that are coming in now into these products? What is the market that you see?
So, I mean, obviously what we see is that it's probably difficult for big institutions like pension funds to go into something that is so volatile. So we've seen more interest recently for the what we call the alpha one, which is really non-directional because it's pretty steady. So an investor might think, okay, I get exposure to this new asset class, but I don't get the volatility and the beta, so it's quite attractive. Mm-hmm. But if people have more risk appetite and but you have to size accordingly. It's always a question of sizing as well. So you don't need to have too much of a large exposure, but you can choose something with a bit more like still alpha, but a bit more of beta as well.
But I want to dig a bit deeper there. So what are the exact types of investors there? Because I guess everybody in the room is interested. So what is the landscape here?
Well, and asset managers, large family offices, where using the strategies that he just said, I always like to call it, we're putting more airbags into the vehicle so that when they have to answer to their clients, they know that they have selected something that has been managed in a capacity that is risk-focused. And what I mean by that is we're addressing risk. We're trying to reduce that volatility so that the manager or of the family office manager, say the asset manager, can feel comfortable that they are not putting their client into something that is going to put the portfolio in a downside.
What are your estimations of proportions in a portfolio for that?
Of the client type, you mean?
Yes.
I would say it's probably a majority of family office high net worth.
The percentage in an asset allocation?
The vast majority, probably.
Within the total portfolio that they manage?
Yeah.
You mean in their portfolio?
Yeah.
Well, probably very small.
Still quite early days.
All right. So you see larger parties coming to the show, or is it more really diverse asset managers?
Yeah, I think that we're
first movers.
I think we're pretty cutting edge. I mean, there are other people in the space, but for what we're doing for a venture capital firm in Crypto Valley, teaming up with an expert in the hedge fund space, also in Crypto Valley, essentially, in right next door. I think that gives us a very nice leg up on the competition.
You both can make a last statement here. I would say let's just expand that universe of investment products, but maybe you want to say a word?
I think there's enormous opportunity coming, and if anybody in the audience would like to hear more, please approach myself or anybody on my team, and we'd be happy to tell you more.
And come back to the summit, by the way.
Yeah.
So,
no, I mean, look, I mean, it's our DNA, so we think active management is the best way to approach the asset class.
Okay. Yeah. So congrats on the progress that you're making. I hope you find a lot of people to talk to, and congrats on the work you've done.
Thank you.
A lot of success with that. Thank you very much.
Thank you.
Thank you so much. Insightful and relevant as always, and thank you for all the work you're doing. Best of luck going forward.
Wonderful.
Thank you. So our next speaker is going to talk about the importance of Web3 security and what tools we can use in the ecosystem and Web3 projects. Jason Chow is the COO of CertiK, the biggest Web3 security firm in the world. Now, he was formerly the CEO of Biomedical Instruments, Vice President of Shanghai Unigroup, and Director of Broadcom. And he's here to give us insight tools and maybe even best practices when it comes to Web3 security. So please give it up for Jason Chow.
Hello, everyone. Indeed, they warned me about light. I didn't know it's so bright. It's good to be here. Thanks for the invitation from CV Lab and CVVC. It's great to be here to share some of my thoughts on the Web3 status, where we are now, where we'll be going, and what are tools we actually need to use to reach that goal. Everybody knows that we had a fantastic 2021. You can see from the first chat, you can look at the total TVL locked in DeFi. At peak, we were at like 183 billion. Then, boy, what a year this year it is. And we obviously had a setback. The number dropped a lot. It's at probably around 60 billion now. But then, this is a temporary setback. I think everybody knows in this industry. Nothing goes like in a straight line. We all talk about the winter is coming, but then I truly believe if we look back in 10 years, this is gonna be the start of another boom. Why I believe so? Because you look at the innovation, it's really still innovation powered the industry. The number of the apps is still increasing every month. The number of protocols supported by major chains increasing every month, although at a lower speed. And actually we have also seen some newcomers, like very traditional like company getting more serious into the blockchain industry. And so one of the biggest challenges we have in the space is security. So what's the status of security now? Anybody have heard of hacks in the last 6 months? You can raise a hand. Yeah, I think almost everybody, right? I think we see hacks, incidents every month. As CertiK, we actually track all the security incidences. This is the stats we see. It's not a good picture. This year, we already lost 2.3 billion as a total loss. And then this is almost already double the amount that we lost last year as a whole year. And we have different types, basically the hacks, traditional hacks, hacker explore, code vulnerability, governance, policy holes, administration right access issues. And for that, we lost 1.8 billion. And there were also people purely have a evil mind. They launched the product, they pull out a fund, then abandon the project. That's what we call exit scam. So far, we lost 133 million. And we also have people who leverage the flash loan to attack DeFi vulnerabilities. For that, we lost 339 million. So it's a lot of money. And also, we are seeing trend of people actually using social engineering to hack Discord, Telegram groups, and using phishing website to exploit, to kind of take advantage of the security vulnerability. So these are all the challenges. How do we solve it, right? So we, as a security firm, we believe the end-to-end security solution is needed. Everybody now, I think, understand the need for audit. Basic audit is a security assessment of code before project get launched. And most of the projects actually stop there. They did the audit. Well, actually, I would say not most of the projects. Some projects even not getting audited, which I think it's not a good practice. Everybody should get an audit for their security code before they launch. But then a lot of projects stop there. But we believe to have an end-to-end solution is very, very important to secure any project. This includes KYC, we run bug bounty services. We also provide 24/7 on-chain monitoring services. We help project to monitor their project status. We flag anything abnormal that's happening. We also can provide threat intelligence, and to kind of prevent something unusual or kind of risky that's happening, we can let project know earlier. And then also, no Web3 product is actually kind of standalone yet. Every Web3 now have a Web 2 component. That's why some people call Web 5 or Web 2.5. So you still need to secure the Web 2 part of the component. That's where pen test is involved. So, and also, because every project to stay competitive, they have to keep upgrading, keep innovating. So the auditing process actually should be a continuous process. It shouldn't be just one time. I think these are the basic building blocks for an end-to-end security solution. So why do we have to kind of secure the project? I think in the end, it's about you need to, for any project to be successful, they need to build a trust to the community. They need to provide transparency to the community. So for that, that means people actually need to have a place they can go and check and look, okay, can I really trust this project? I mean, what is their basic security analysis? What's their security stance? And what are people talking about them on social media? Because Web3 is very closely tied to social media. A lot of intelligence actually get from social media. And also people want to understand what are the fundamentals of projects. For example, you can see the price a lot of places, but then how many users are really using their protocol? How many transactions they are really using the protocol and the app? These are the fundamental data that people need to understand before they can really make a decision to participate in certain projects. So all these things are what we actually are building at CertiK. So who is CertiK? I realized this time a lot of people don't know us in Europe. I figured we should probably come out more. We are a company headquartered in New York City. It was founded by two professors at Yale and Columbia. And we use the most advanced AI and formal verification technology to verify the code and help secure the blockchain, smart contract, and Web3 applications. And we actually currently are the biggest one in this space. In last 12 months, we raised more than 250 million from leading venture capitals that including Sequoia, Tiger, Insight Partner. I think all these names are very well known. And we are building an end-to-end solution. So far, we already have more than 3,700 customers. We already discovered more than 60,000 vulnerabilities and helped secure 360 billion digital assets. And we received various awards you can see from the slides. So here, I can show our key products here on the right side. Basically, of course, we're doing audit at the most. And also we have this 24/7 online monitoring services. We have penetration tests, we have bug bounty, we have Skytrace, can visualize the money flow on the blockchain. And we have customer across the whole spectrum. We have very big customers. A large portion of the top 20 blockchain projects actually are our top 200 projects actually are our customers. And also, one thing that's kind of differentiates us from some of the other security firms is we made a conscious decision that we need to serve not only big projects, but also small projects. That's why we actually consciously decide to enable the Web3 ecosystem, because Web3, the spirit is enable the small guys. So, and these are all the leading projects actually we work with. We work with DeFi platforms, NFT, GameFi, different ecosystem. Okay? It's really a short time. I guess Web3 security actually could be a topic that I can discuss about 2 weeks. So I only have 7 minutes. Thanks a lot for your time and attention, and look forward to collaboration with any project interesting to build a secure health ecosystem together. Thank you.
Thank you, Jason. Really interesting, and I'm sure we'll definitely be following that. And if you do want to speak to Jason, do seize the opportunity to grab hold of him while he's here. It's now time for a fireside chat on investing in tokenized commodities. Now, commodities, as you probably all know, are an attractive asset class, but until now, they haven't really properly featured in investment portfolios, mainly due to physical complexities and costs. But now there are platforms arising that can facilitate this, and one of them, for example, is Tokenized, that we also heard yesterday on stage, and we're going to hear them now today as well. So to moderate this panel, I'm pleased to welcome Lior Groen, who is director at Spartan Group, and that's a leading global digital asset management and investment banking group, fully dedicated to deal making in the blockchain industry with over $500 million in assets under management. So please give it up for Lior and his panelists.
Good afternoon and welcome everyone. It's a pleasure to be here with you today to moderate this panel and fireside discussion we have on the tokenization of commodities. Joining me on stage is Valerio Matriciani, who is one of the foremost industry experts on this topic of tokenized commodities. So please join me in welcoming Valerio to the stage as well.
Good evening.
So Valerio himself has more than 20 years of experience in risk management in the financial industry. He's worked at Man Investments, Raiffeisen Switzerland, Swiss Life, working across their asset management, banking, and life insurance businesses. He holds a master's degree in finance from the University of Bologna, and today he's the Chief Risk Officer at Tokenized AG. So please join me again in welcoming him to this panel. Valerio, it's a pleasure to have you here.
Thank you, Lior.
For those of you who don't know, Tokenized is one of the homegrown heroes, proud to be based here in the Swiss crypto valley. And we're very lucky to have them as one of the foremost pivots and connectors between the traditional financial markets, which we have here in Switzerland around commodities, as well as bringing that into the Web3 space. The organization itself has done a remarkable job of attracting the likes of Glencore, Trafigura, and IPM as their partners, and to date have already executed in excess of $1 billion in notional trading value through their platform. These are the types of organizations and initiatives that we see as transitioning beyond what is just the crypto hype of this blockchain industry. And really, it is one of the most relevant topics in today's world when we're looking what happens beyond the hype of the market cycles. So let's jump right into it. There's been a lot of talk over the years over the tokenization of physical assets, real estate not being short. It seems to be the case that things like digital land in the metaverse, for example, have attracted even more attention and momentum that many of these initial traditional asset bases have been able to do. So cutting to the chase, Valerio, plain and simple, why are you on a mission to motivate, to tokenize commodities, and how do you see this landscape playing out?
Yes, thank you, Lior, for having me. I mean, the commodity sector is a very sizable market. And I mean, if you think about the energy products like oil, gas, or all the renewables, or also the metals that are processed in the industry, or the precious metals, that's a multi-billion, that's a trillion market. So only a few of that, a small fraction, has been so far digitalized or tokenized. So we see a huge opportunity in creating an ecosystem where these commodities can be efficiently exchanged among, for example, the industrial players to secure their supply chain, but not only. We have also in the investor community, commodity is an asset class, it's well established. So, you know, they usually get into an asset allocation into the alternative investment buckets together with the hedge funds, together with the private equities, the real estate. And I mean, investors like it because, you know, it has good properties for example, inflation. It adds diversification to the portfolio. And it has shown in the past very, you know, secular and persistent trends.
No, absolutely. And I think, I mean, you mentioned the topic of inflation. I think that's on the minds of many investors out there nowadays. And really that comes into the bigger macro climate for investing nowadays. I think 2022 has been an interesting year for most investors, especially those in crypto and especially those looking at alternative assets. We heard yesterday here from the CEO of Tokenized on the macro trends affecting and enabling tokenization of commodities, specifically looking at the demand for industrial metals, right? And I think one of the examples they gave was around the rise and transition towards electric vehicles and the resource requirements, where that now is a huge demand growth around copper, lithium, and other industrial metals. I mean, how do you see that evolving, and what is the role of tokenization in facilitating investment into those areas?
Yes, I mean, our platform, for example, can be used to tokenize these metals, you know, where the industrial players, they can manage their transition, this energy transition, but also investment players, actually, they can get exposure to this particular investment team that is growing and is, you know, all over the place currently, and it's, you know, it's a very good investment.
And does that mean you see more capital coming into the industry to be able to finance that innovation? I mean, is this an enabler for people to get exposure to an asset class while also financing that transition? Is that how we should be looking and thinking about this?
Yeah, I mean, currently, you know, if you want to get access to these commodities, you know, usually as an investor, you go through a wrapped instrument. Like, you know, out there are the global financial product factories. They've wrapped the commodity exposure into, for example, a fund structure, or they create an actively managed certificate in AMC, or, for example, they create an exchange-traded product in ETC. But these products, they tend to just passively replicate an index, which is based on financial futures. And that's actually, you know, has an impact on performance. While if you look at, for example, the commodity that is created via digital asset, it can have access directly to the spot exposure. And that's actually have a material impact on performance.
So, I mean, if we take a concrete example of that, I'm just thinking, I mean, we obviously have ETPs and ETFs and many other structured products, right? So what is it specifically about this that enables you to cut through, let's say, the intermediation and the fees and create an attractive, more attractive investable instrument for specific physical commodities?
Yeah, I mean, we can make an example of an ETC, for example, a copper ETC. What happens there when an investor buys the ETC, the special purpose vehicle, the SPV, that issues that security, to create that exposure for the investor, he normally enters into a total return swap with an investment bank. So what they do is they exchange for a swap fee, which the special purpose vehicle pays, like LIBOR plus 30, LIBOR plus 50, whatever, on an annual basis. He receives the SPV from the investment bank, he receives the annual performance of an index. But now here's the thing, the index itself creates this performance by applying a very simple systematic strategy, which is going long, for example, the front month's future contract, copper contract. And then when he is very close to maturity, instead of taking the physical delivery, he offsets that exposure and enters into, he rolls over the exposure into the next near to maturity future. And that way, actually, the investor in the end that received that performance is not only exposed to the spot price of that commodity, but also to the term structure. And this is actually, you know, has an impact on performance, because you have to then to account for all these rollover costs, this negative carry that is embedded typically into that rolling strategy.
So I know we've spoken about this previously, but the TAM structure, maybe you want to just explain a bit more what that is for the audience so they understand the composition of this instrument.
Yeah, I mean, the term structure is because there is various future maturities that you can buy on the futures market, and they have all different prices. And usually the curve is in contango, so it's steep, it's growing. And therefore, when you offset your near to maturity future, you get a smaller income, let's say, with respect to what you pay to get exposure to the next maturity. And if you do that systematically, you have this negative systematic carry that drags on your performance, as opposed, for example, if you are exposed just to the spot price. And the digital asset that, for example, an investor can buy, it is actually structured in a way that the token, for example, creates a representation of the metal, in our example of the copper, that sits in a warehouse, that is custodied in a warehouse. So therefore, then the investor, through the digital assets, he gets the exposure to just the spot price, but has an additional nice feature that he does not have to care of the whole logistic of handling the physical asset. And that's the big advantage as opposed to, let's say, traditional investment, also into the physical asset itself.
So I think, you gave the example of copper, and I'm sure many people in the audience today are very familiar with some of the other, let's say, gold-backed commodity token, other types of commodity-backed stablecoins, such as gold products, Paxos Gold, and many others that are out there. What is it specifically about copper that makes it, and other, let's say, industrial metals, that makes it different from some of these more conventional products that maybe already exist?
Yeah, it's to these spot-based products. The prerequisite is that the capability, besides, let's say, the technology, obviously, to create these tokens, is the capability of handling the physical assets in terms of procuring the metal, in terms of storing the metal, in terms of reselling the metal. And obviously, in gold, it's a liquid market. It's very diffuse. It's also easy to store. Let's say it's a small piece with a big value. So there you have already, these global players that are creating, thousands and thousands of ETFs in the equity space, in the bonds. They have currencies. They can handle these. But as soon as you go into, for example, copper, where you have these huge bundles of copper cathodes that you have to procure, that you have to store, it becomes less. They become less incentivized to set up a whole infrastructure to create a spot product, and therefore the clientele, the investor community asks for this exposure. They look around and they see financial futures which they're used to, and they replicate that instrument and provide it to their investors, which is already a very efficient, let's say, way of accessing the commodity space, the less, let's say, gold, beyond gold. Because in the past, if you wanted to get exposure to copper, for example, you had to buy, for example, a mining stock. Now you have these ETPs or ETFs. But now here with the digital assets, we're going a step further, because you really have the asset itself, which is stored, digitized, and available for an investor to be held in a wallet, and also to be transferred and traded on a platform.
I have to say, even for, let's say, a layman like myself, what you're saying actually seems to logically make sense, right? And I think when you have that kind of momentum behind a new product innovation, the question that we always ask, as an investor on the buy side, would be, why has no one else done this? So what is stopping, some of the other providers? And we mentioned, obviously, Glencore, Trafigura, people that have partnered with you to do this. So what is it that they see, with you, and why are they not doing it themselves? Really, is kind of, I guess, something we'd be curious to understand.
Yeah, we provide let's say, the platform where these issuers can bring their products. They already handle the physical commodity within their own processes, and now they have a way to efficiently bring also investable products to the market via we have a tokenization platform, so we can actually bring these instruments to the clientele. And we have done some some analysis, for example, in the copper space. We have created, just to give an example on the, let's say, this impact of the term structure, this negative carry that you have embedded in these ETCs. We have created a pro forma track record of a digital asset, like a copper asset, over the last 12 and a half years, ending mid of last year when we did the analysis. And we have added to that spot price 100 basis point of total expenses to, let's say, manage the digital asset, but in reality, mostly to manage the physical assets in terms of insurance, in terms of storage, and so on and so forth. And we have compared that on a net performance basis, so including the 100 basis point annualized cost, with an ETC that is available in the market, which has this future-based exposure. And the results is very material because the outperformance over the 12 years, it's more than 1% for the digital asset, wow, which is a 1% per annum on average. So if you think about also in terms of compounding 1% over 12 and a half years, that's a material impact. And the reason for that is effectively this negative carry, this rollover cost that are embedded in the futures market.
So I think there's a lot of people in the audience who'd gladly sign up for an additional 1% annualized on their returns. I mean, any final words or remarks on how you see this playing out and what your next steps as an organization are to really deliver on this and bring it to the market?
Yes, I mean, we are continuing to grow our ecosystem. Obviously, there is a big part, as you mentioned, we are already live with the whole industrial case, but now we are going to launch in Q4 these investable products. They're based on full bars, so they are available as a full bar exposure to various metals, both the precious metal as well as the industrial metals like nickel, like copper, and so on.
Excellent. Well, once again, I mean, I think it's really great for us to see, that convergence between the traditional commodities markets that Switzerland's very known for, and seeing startups like yourselves come out and bridge these two different worlds. And obviously, I think the nature of the game is really adoption when it comes to digital assets, and certainly by creating a new market here, I think we're able to see how that really takes some significant strides forward and brings some traditional capital and capital allocators into this digital asset industry. So on that note, Valerio, thank you very much for joining us today. It was a pleasure to dive into this. And for those of you who are interested in finding out more, of course, Tokenized has its website and LinkedIn page. I'm sure they'd be glad to have some additional people looking at that and seeing what they're up to. And I think, as you mentioned, in Q4 this year, they're launching a suite of new spot products. So for those people looking to get exposure to some of these spot markets for commodities, I think this is one of the places to do that, and certainly the front runner in the industry. So thank you very much. Appreciate the time.
Thank you, Elon.
Appreciate it.
Thank you so much, Leo. Thank you so much, Valerie, and best of luck going forward. So, are you energized for a last panel session? Woohoo, thank you. It's nice to feel a bit of energy. It's amazing that so many of you are still here, and also, of course, all our online viewers. So we want to sort of have a panel that really ends on a positive note, as we're going to look at, the industry's future, and also look at the tech builders here in the Crypto Valley, because there are lots of interesting, upcoming, and also established protocols that are coming to and already are in the Crypto Valley, and that are sort of driving the next generation of protocol world. And we're going to meet 3 of them now and sort of see what this all entails. And we have an eminent moderator to facilitate us through this. It's the managing director of CV Labs, who's been really orchestrative in, of course, putting on the CV Summit. So give it up for Tracy Traxler and her panelists.
We're a lot smaller today.
All right, we have a big responsibility, guys. We're closing out not just the day, but the summit itself. But we figured it makes sense to take sort of a positive reflection, not just on the last 2 days, but particularly on what is in store in the future. So I am joined by 4 highly qualified individuals. The first to my left is Michael Holdman. He's the founder and CEO of the Prasaga Foundation. Now, Michael, you're an IoT, smart city global industry thought leader, and you firmly believe that the solution to the root of our problems is decentralized networks that ensure that the individual is control of their data and their destiny. Welcome, Michael. I'm also joined by Greg Chu, the founder and CEO of QPQ. Greg, you're a finance and legal professional. You're a father of 5 and a husband of 1, you lovingly said. You're a passionate advocate of the economic emancipation of humanity. So we have a bunch of philosophers on stage with us, which is exciting. Third, we have Brian Gallagher, the co-founder of Partisia. Now, before you co-founded Partisia, you also co-founded undergroundseller.com, which is a leading e-commerce wine marketplace in the US, as well as Insights Network, a blockchain software development company. You have 7 years as a co-founder in the blockchain space, have raised 75 million in funding for the various organizations that you're part of, and of course have and continue to hold several patents from the US Patent Office in the blockchain space. And last but certainly not least, we have Ralf Kubli. He's a board member of the Casper Association. Now, Ralf, you're an experienced executive with a strong background in blockchain, crypto, and of course, decentralized tech itself. Your career spans roles in M&A, sales, executive management for fairly large corporations across the globe. And of course, you're an avid golf player, which I can attest to because I've seen him in action. So thank you so much to the 4 of you for joining me today. Without further ado, I'd like to dive into why we're here today, which is to take a look at sort of unicorns in the making and where we're headed as Crypto Valley. The 4 of you, of course, represent projects with teams that are truly global. And yet, you also represent 4 projects, rather, that have all chosen to settle in Switzerland. So my question is, what value does Crypto Valley hold for the global ecosystem, particularly when it comes to the development of the tech itself? I'd like to start with Ralf Kubli.
Well, I think, for Casper Association and the Casper project, setting up in Switzerland was a search basically globally for the right ecosystem and the right regulatory framework. That's kind of like the short answer. The longer answer, of course, is that here we have a very vibrant ecosystem where you actually find the right people to have many answers to your questions. You may not necessarily find all the tech talent that you want. You have to find that globally because not all people find Zug, the greatest, but we do, so that live here. But of course, you will find good talent, certainly on the architecture side. And, regulatory clarity is one, but, it's also the concentration of founders and builders that want to actually contribute in a safe and clear environment and build the next generation of commerce or infrastructure. That we are all here engaged to create.
Brian, do you echo that sentiment?
Yes, it's similar for us. Partisia was and still is a commercial sort of enterprise software developer of advanced cryptography solutions. And so it has a long track record since 2008. Some of the other co-founders are Ivan Damgaard, Jesper Boost Nielsen. So they have decades of research and development work. And so for them, it was super important to sort of find the jurisdiction that supports what you're doing as a utility token, and Switzerland's for sure the gold standard. Reputationally, if you were to launch a blockchain protocol and sell a token, if you do that from a private company, back in 2017, that was very acceptable, but now being a foundation gives you a lot more credibility just to be able to, have your community understand that there is some oversight into how you're conducting business and managing budgets. And we just completed our first audit. So we went through the process, and now I fully understand. It really is better than anything else we've seen. They are on top of, your organization and how you're handling business. So it's definitely a good sort of like second layer governance to how you would just conduct if you had no oversight. So,
Great.
I kind of think you asked the wrong question. What choice was there? Because we looked at this. Yeah. I'd been looking at Crypto Valley from when I started this again in 2017. We were in a barn behind Intel in Leixlip, Ireland. And I knew this was where the market was, but ultimately, I kind of had this idea that, well, it's a global market, we can sell from here, but there are a number of things that are really different. The first is, when you talk to FINMA, well, first of all, when you send documentation to FINMA, they actually read it, which, so far as I can work out, is a first for any regulator anywhere in the world. Because every other regulator I've gone to, we basically end up going, so did you read the information we sent you? No, you're going to present that now. And I was like, oh, why did I bother sending 80 pages of dense text to you that actually explained everything if you just want me to explain it to you again all over again? What are we wasting 2 hours for? With FINMA, we got 2 minutes into the conversations. Yes, we've read your papers, we understand that, move to the next question. That, for me, was just a mic drop moment, right? That's one. So regulatory environment is really intelligent. They listen, they talk. I'll add to that, you have the cantonal structures where the cantons actually have real power, a bit like the states do in the States, that there's quite a considerable body of effort that's invested in that. Albert from the economic office here in Zug was a superstar, got us stuck into the system. Every time you talk to him, he's saying, yeah, how can we help? What can we do? Having that conversation in Ireland is fantastical. It will never happen except on a complete fantasy. And the other part to it is this, it's really simple. If you're in fintech, you're either in London or you're dead, okay? 60% of all the money that goes into fintech goes into London. And fintech and DLT are not the same thing. They're not, they touch into one another, but they're not the same thing, because fundamentally they're building applications on top of the existing infrastructure, and we're talking about transforming the underlying infrastructure. If you're building something in social media, you go to Silicon Valley. So really, if you're building something on DLT using blockchain, you're either in Crypto Valley or you really aren't anywhere.
Now, of course, Michael, you bring a US perspective to this, and you very recently decided to settle in Switzerland.
Yeah. First of all, the reason, regulatory guidance. That's number one out. We are a US-based organization as far as we're all US citizens. So the majority of us are US citizens. We've got a couple of UK, Japan, Colombia, and others, but the majority, and at least the leadership team is. And the fact that there's absolutely zero guidance whatsoever in the United States, just, it upsets me. We're members of the Chamber for Digital Commerce, which is the largest lobbying firm for crypto in Washington, D.C. And through that council membership, we're engaged with senators and congressmen and such legislators all the time. And I tell them, look, it just kills me that in my KYC that everybody has to do, KYC, AML, in order to be part of our the pre-sale, I have to have United States listed next to Iran, North Korea, Sudan, Somalia, and all these sanctioned terrorist countries, right? And for a 58-year-old man that has been a U.S. citizen all his life, it really tears me up. And in fact, one of the things I asked the legislators is like, why don't you at least look at what's going on at least look at the guidance that Switzerland gives? Although it's changed a little bit, but at least it's under the guidance, the legal opinion we have, we're a payment token and a utility token. In the United States, you might be, but you could be a security token sometime in the future. And it's like, well, you're not grandfathering me in or anything on this, so I just can't do it here. The government in the US, or at least the legislators, are really upset because of the fact that all of this technology is leaving the United States, and they're not able to really participate in it unless you're a SEC-sanctioned Reg D or Reg A and fully compliant and selling securities.
Yeah,
so it's absolutely regulatory guidance.
One of the really difficult parts about the States, I think, is that you have so many different federal, state, and state bodies. I mean, I did the Series 79 exams, and you had to do a Series 63, and then it was how do you go from other states, so different ones would require different registrations, and you have this constant conflict between the states as one level, but then you have a whole other layer where you've got federal bodies fighting with each other for which ones get to regulate what, and you're kind of stuck in this state.
I think there's 27 different proposals now put in by different legislators as far as crypto regulation and such, right?
Yeah.
And the latest one was fantastic. It's a congresswoman and a senator that put this bill together, and they actually, one of the things in the reg is that all DAOs have to register with the U.S. And I'm like, well, how the hell does a DAO register, right? Who exactly is going to do that? And that's the problem when you get with the politicians and such, and even their staff. They're all lawyers, right? They're all Ivy League school. They're fantastic at law. They understand constitutional everything. But what they don't have is an understanding of how things actually work or what structures are in those, and they don't really care about it because they're
looking at the wrong thing.
Yeah.
And I think, look, the thing that Tracy, that we're all saying to you is the same thing, okay? And the way I try and explain it to people is that assuming that America continues to be a basket case of being unable to fight to work out who does what in what context, and then get down to the state level, I think you're probably 5 years away from having an answer, right?
Yeah.
So my
if
view
even
is,
that, they don't want to.
well, I'm being optimistic, okay? But
Very optimistic, but yes.
But in my view, if you really want to understand how this is all going to change, you look at the driving forces. The mother and father of invention are forced. So the hostility of the European Commission towards Switzerland and toward the UK is going to force both of them to work together better. Actually, they're complementary markets. The UK is a commercial banking center, Switzerland is a private banking center. Singapore is the other part of that puzzle on the other side. So it's two hemispheres with commercial banking, with Zurich in the middle. But it's more fundamental than that. And I come from a kind of, my father's family, engineer. I think of it like this, that Switzerland is like the ECU, and Singapore and the UK are, depending upon your point of view, the engine or the gearbox. The guidance, the leadership is going to be here. And unfortunately, America are going to be very lucky if you're the tow hitch.
Yeah, no, I agree.
Yeah.
I mean, make a stand. Either do what China did and say no, never, or
figure it out.
Give it guidance. Yeah, but say something. Yeah.
I saw lots of nods of agreement from your American counterparty over there,
Yeah.
Brian. I think you felt
It
the
is
pain.
quite embarrassing seeing our country's name next to Iran, Venezuela.
Yeah.
You're done down twice, because actually you're Irish American, and in Ireland we have the least willing. So the conversation with the Central Bank of Ireland goes as follows: so what are you doing? We're building a new infrastructure for distributed. Get out.
Yeah, well, you know.
No, but I think luckily we seem to be in better hands here in Crypto Valley. And of course, Crypto Valley specifically has a deep history when it comes to protocols, right? Starting with the formation of the Ethereum Foundation back in the day, and figures like Albert, I'm very glad you dropped his name, of course, play a very central role with regards to specifically that early formation of crypto's place here in Switzerland. Now, within that rapidly expanding, some would say mystical realm of layer zeros and layer ones and layer twos, which you guys represent, what is it that separates the unicorns from the rest besides that coveted billion-dollar valuation? Brian, I'd like to start with you.
I think it's going to be who brings over traditional economy into Web3. There's new use cases coming. I commonly cite trade finance as a good one. And there's $2 trillion a year that goes unfunded in trade finance deals, mostly affecting small, medium enterprise. If you're able to create shipping products, like if an Ethiopian toy importer is buying toys from China, HSBC is not going to back the deal. But they could be reputable companies with a long history. You could open that to the DeFi economy when the shipment's created and it's actually logistically moving through the supply chain, leaving the port of Beijing, or not Beijing, like Shanghai, for example. You could then make that a token on the chain, and it can trade in a Uniswap type environment. So you can open lending to the DeFi economy, to the DeFi apes. They like to take high risk. Trade finance has 14% interest rates on 60 to 90-day deals. So we're talking about trillions of dollars that is in need of funding. So if you can bring these types of use cases onto a scalable blockchain with built-in privacy, for example, then you're going to see unicorns, because you're solving a major gap, right? It's literally called the trade finance gap. So if you can solve a gap like that, it's a unicorn. So I think we've seen the progression from Bitcoin to ICOs to DeFi to NFTs. So now the next unicorns are going to be bringing, I think, more traditional business use cases onto the blockchain.
Ralph, what is it for you? I know you have a soft spot for capital markets, for example, but what is it for you?
No, I think when you also think about the future unicorns, so obviously adoption of use cases, on these infrastructures, of the real economy, if you want to say so, is going to be key. I think it's also we have to ask ourselves what kind of infrastructure are we building for developers and enterprise to build on, and I think that answer. I think we all have a particular take on that, whether it's in a specific industry or in terms of the approach. Now, Casper, firmly believes that, adoption will, come from the enterprise space, or the key for adoption is the enterprise space. The key for adoption is to use this technology in existing enterprise architectures or software architectures with developers that are not necessarily having just the blinders on for EVM compatibility, but for actual, solutions in an existing application environment that requires, maybe a little bit more advanced technology than an EVM. So we really have to be honest about that. And, the pool of people that want to build real solutions outside our little bubble here, there's millions of developers that are waiting, to solve that on infrastructure that hopefully we are building for them to do that.
I know, Michael, you guys are targeting developers at the moment, right, with a lot of your initiatives. What is it that you think will motivate developers to make exactly that jump into the space if they aren't already active in it now?
Well, the first thing is you have to have, and it's not about, the developers. I mean, we chose Python for our language. So 85% of the world's developers use Python. Why would you go with something that has a pond full of developers when there's an entire ocean out there, right? And it's a very good language. It's an easy language to understand, and it works well with the way the approach that we took, but without the smart contracts. Where I think it is the catalyst to large consumer adoption is going to be utility to the consumer. Back in 1999, the approach has to come through the enterprise. Back in 1999, none of us went to the banks and said, I want to do all my banking from my phone. I just want an app here and I want it to be done. The banks, we trust them. We might hate them, but we have our money there. We trust them. They came to us with this application. And this application, all of a sudden, even though we were hesitant at first, but sooner or later we go, well, I put my name here, I put this name here, I put this amount here, and I hit send. Wow, that's easy. That's utility for me. That makes my life easier until we get to a point where the applications that are on the DApps, or the DApps that are on the blockchain, are satisfying the other 96% of the population that's not within the blockchain or crypto market, is when we're going to get that large consumer adoption. And it's not by doing more trading apps or doing NFTs, because we're talking about people that want to buy bread and milk and pay their insurance and do other things that give utility to them. And that's where I feel it is.
Yeah, I'm glad you already made the leap to dApps, because that's where we're headed next. And I'll direct this one specifically at Greg. When we look at how the dApp ecosystem is, continuing to gain steam, and scalability is becoming more and more of sort of a crucial bottleneck for Web3 progress, how should protocols and the industry as a whole approach the scalability issue, and what role will interoperability play in the ecosystem's future development?
Okay, so probably the best way to begin that is by defining interoperability, because I think it's a misused term. And actually, one of the big problems I think we have in DLT as a whole is the abusive terms of language that otherwise people in common parlance would understand very well, and it isn't what we mean. So interoperability is the ability to use something in a way that is interoperable with something else. So, what it isn't is it isn't a series of bridges. It's not interconnectivity. And when you have interconnectivity, so each one of us is connected by a bridge, you're actually destroying the point of a distributed ledger technology in the first place, because the whole point is that you can trust the message, not the messenger. If we're reinstituting third-party bridges in order to connect each of the five of us as 5 protocols, you've reestablished the need for third-party trust. You're creating new bottlenecks. You're creating new land grabs. And the whole point of this is actually that we're creating a new economy that everybody can participate in, where everybody can add their value to it. This is what we talk about when we talk about the emancipation, the economic emancipation of humanity. So really, sort of echoing a little bit what Michael just said, it's utility, but I think it's actually a step beyond that. It's convenience. If you think about it, the statistics are very clear. Only 5% of developers will use bridges. These are people who actually know this technology really, really well. So go outside of the bubble that we sit in today and ask if people would really want to do this. The answer is no. So our approach was really to say, you know something, there's loads of layer ones that are really good. They all have their own USPs. So if we can combine them together such that somebody has got this interoperability capacity where they're getting consensus as a service, they're getting bridge as a service, we're honoring the rules of distributed ledger in that you can trust the message, not the messenger. But actually, from a user perspective, everything in the background just falls away. Because in Web 2, you know, just like Michael said a second ago, we go onto our app and we do this, and nobody thinks in the background what happens. I actually talked to the guy from IBM who designed the trading, that system that you're talking about for Nedbank in South Africa. And he showed me the graph of the number of systems that have to be polled in order to give a simple account balance on that screen. And it was frightening. And bear in mind, South African banks are actually a lot more advanced in terms of their technology than a lot of the big Western banks. So I would dread to think what that looks like if you're going to HSBC or Barclays or Bank of America, right?
Well, it's the same as telecommunications. They kept buying more telecommunications companies, and none of the equipment talks to each other, right? So they still have these siloed systems within their own system.
And that's our view, is we're saying, look, all of these layer ones have got these capacity. And actually, telecoms is a great euphemism. So I talk about, here in Switzerland, there are 3 networks. You've got Swisscom, Salt, and is it Sunrise?
Correct.
Okay. So everywhere there's 3 masts, and if you pick out your phone and you're with Sunrise, you'll only get Sunrise's mast. He picks out his phone and he's with Swisscom, you only get Swisscom, and me Salt, let's say, for example. I think that's kind of stupid. Why can't we have a virtual network that says the nearest mast to you is the Salt network, but actually you don't just want to have a phone call, you want to download a file. So the nearest mast to you with bandwidth capacity is the Swisscom one. Why do we have to have these ecosystems that basically say, you're in my ecosystem and you stay here and that's it? And bear in mind, a lot of the layer ones are not making a penny because they're paying people to use their networks. They're paying people to come in. In reality, what they should be saying is like the telecom companies, I want throughput. And our view is, well, we'll give you the throughput because every single transaction in our system gets public consensus. That's the rules.
It's a big UI UX question as well. It's a big UI UX question as well, right?
Yeah,
what do you experience as an end user, really, at the end of the day?
Exactly. And you go to our website, there's a demo there on the landing page. It takes 40 seconds to set the whole thing up, and you make your choices, and you've got everything you want and everything you need. You deploy your dApp, and you go. And from your user perspective, there isn't this amorphous blob of they have to know all these other pieces in the background. There's just a really good UI. And you know, the thing I keep saying to people on LinkedIn is, stop making excuses in Web3 for building crap. Because the reality is, if you build something that either fulfills a need, fulfills a desire, or solves a problem, you will do really well. The infrastructure is now here. And you know, all of the people on the stage here are talking to you about providing different layers of that infrastructure. It's here now, so get on with building. Start building things that people will actually find utility in, that people will use. And stop blaming the lack of infrastructure. That's a historical problem as of this last few months.
Yeah, real quick on your thing about ease of use. We have a great example of that. My co-founder, Jay Moore, his largest startup he had was something called Garage Games, first ever open gaming engine in the early 2000s. Sold it to Barry Diller for $70 million in 2004, right? Unity, which was based on Garage Games, IPO'd for $32 billion 4 years ago. The difference was Garage Games was command line and script. Unity is drag and drop GUI, right? So it's a much easier. In Garage Games, they were doing for like $100 a license, a seat, and Unity was $1,200, but it still had that increase in value because of that ease of use. It's another thing, that UX, UI, that experience that the user has, especially the consumer, average consumer. If it's not something that's simple for them to understand, then they're not going to do it. But yeah, exactly.
You're dead right. And you know, when I was in Barcelona speaking about this very thing, I said, you know, how long does it take for someone to close a web page if it doesn't load? 3 seconds. That's what we expect. And until we deliver that, forget it.
I think Ralph had a comment as well.
No, I was waiting for your next.
Good. Well, I would like to take some time to reflect on the last 2 days, because over the course of the past 2 days, we've heard about plenty of sort of the bear market's implications for investors, both on the retail side and on the institutional side. But I'd like to turn the attention specifically to what it means for developers or projects. So some hail the bear market as a so-called golden age for builders. Would you agree? And what are you focusing on at this particular point in time? Ralph, I'd like to kick things off with you.
Well, I think, as a protocol and as a layer one, it is helpful that the noise level has decreased dramatically, right? So it is interesting to see that institutional investors who have now come to the same conclusion as we have, which is that there are real things being built and there is technology that is relevant here. That they are looking systematically at layer ones. I mean, your success, all of your successes in raising is a tribute to that, and so is Casper's. So then it becomes easier to talk to infrastructure providers that already exist that we would like to integrate, for example, right? So maybe they still want us to pay, but the bill has been reduced quite a bit, and they pick up the phone, right? They answer your Telegram message, right? Because previously they just had 55 people bothering them. Now they only have 2 with a serious value proposition bothering them, right? So I think that is an advantage. But of course, it is kind of frustrating, with the decrease in price, we can do less, since many of us, the assets that we have on our balance sheet, are the tokens, and we have to do something with the tokens. And we incentivize developers, and we need to excite the community. So that is a challenge, and will be a challenge as long as this bear market will persist.
Brian, you're nodding in agreement.
Yeah, it's good to be able to optimize for security and performance rather than noise. And when you're caught up in, when you have a freely trading token economy and there's tons of noise and pressure to be outperforming the competitor assets, you can tend to drift towards optimizing for the noise and marketing. We're in a good position because we had all of our fundraise in USD. So the noise is kind of gone, and we're able to really hone in on the roadmap, and we're actually outperforming in terms of the timelines of our roadmap. So it's good if you're in that type of position. I think it is a bit tough, though, for new projects, because you need money to grow realistically. And layer ones are completely different from an application. Layer ones need a ton of money. Applications, maybe not so much to get started. But if the funding dries up, it's going to be difficult for new projects to get off the ground.
Lots of bootstrapping.
Yeah.
I think the really interesting thing about this crypto winter, in terms of what it means about builders, is that maybe people might start to figure out that actually, as Michael has said, utility, I think we've all said that use is important, that people stop trying to build something with the purpose of number go up tokens and start building something that people will actually play or use. You look at the games that people are still playing. What happened with Minecraft and their view of everything with NFTs? It's really about getting that experience right and making the pieces in the background fade away, because nobody sits there in Web 2 going, do you use AWS or Azure? Because I only use people who use Azure. It doesn't happen. And nobody cares, nobody looks.
Something else interesting to note is that it's not a bear market for everyone. Some of the big finance groups in this industry have made more money than ever recently, and they're still funding projects. And that was not so much the case last time around in 2017, 18. I didn't see much financing activity from any of the big groups, but some of them are better off than ever right now in their funding. So it's not completely crypto winter per se.
If you seem to strongly agree.
Well, I was leaving Michael the word, but yes, I mean, look, there's a number of people that have raised a lot of money. This money needs to be deployed.
Yeah.
And so that's an opportunity for the space. So it's not all gloom and doom.
No.
And we see that. I mean, we see that also on Casper, but I see that with other projects. But it takes a little bit more effort. But again, the less noise is helpful.
Yeah.
Michael, you want to
as far as us, I mean, on the funding, it's always, it's a very technical because it's a very complex system that we've done. And one of the things that we've always had to do, because our goal is not to be a speculative asset. Our goal is actually to become have a stabilized purchasing power of a coin, so that people can use it as a global currency. We've got 2 economists that are working diligently on this. And so one of the things, like they look at your tokenomics, right? And well, there's 2 things. First of all, a lot of these groups have never been in an enterprise or an equity-based funding round, because in an equity-based, you issue 10 million shares, but you only allocate 1 million of them. Well, then the market cap is based on what is allocated, right? The rest of it is nothing. Well, here we have a tokenomics, and they look at what the projected total is, which is just a projection, and they go, oh, well, that's your valuation day 1. I go, how can you even look at that? We got circulating. We don't know if it's going to be there. It could be larger. And then the other thing that we have issue with is the hard cap, because we have none. The fact that we can dynamically work the supply chain so that it's in line with the rate of velocity, so you have 0 inflation or 0 deflation over whatever the total debt is at any point on the chain. It's harder to grasp, right? But the thing is about this, there are very serious organizations that are looking. They come in with larger money, right? With larger funding. It's not a bunch of the little ICOs that you had and 5,000 people coming in and raising $100,000 or something like that, right? So there's a lot more sincere focus. And the one thing I really do appreciate, a lot more diligence done here, because that's one of the problems that was plaguing this in 2018, 2019, 2020. They would see a white paper and they would see a couple equations in there, not even doing the math because the equations mean nothing, but fund it because it looks like this must be a really smart guy because there's math equations in the white paper. I appreciate the smarter money being available during these down markets.
Yeah,
right?
absolutely.
Because that's what it is, a smart money that does that. And that's only going to enhance your project, because you have people that are going to have more care about it and such like that, rather than just go one list every 3 days in your Telegram channel.
And I think that's a wonderfully positive note to end on. Thank you, gentlemen, for your time. Greg,
one small thing.
One last sentence,
right.
and then we unfortunately have to head on into
There's a lot
the
of
final
institutional
goodbyes.
money now coming into this. There's a lot of funds that are specifically looking at blockchain infrastructure. We're raising, so come and talk to us.
So we all are.
Yeah, lots of opportunities represented on this stage, that's for sure. So thank you to the 4 of you. Thank you so much for having this wonderful discussion. Thank you to our audience, of course, for staying until the end and joining us. I get to dismiss the 4 of you, and I get to welcome Savinje back to the stage. Thank you so much.
Thanks, Tracy.
Thank you so much. Thank you so much. Might be reaching out. Might be reaching out. Wow, Tracy, what a great way to sort of conclude these 2 days with a topic that is very much on a positive note. And just to sort of conclude, because you've been very operative in this whole operation of the CV Summit as Managing Director of CV Labs, standing here now at the end of this year's edition.
Indeed, indeed.
The sports question, how does it feel?
Ooh,
come
it feels
and
great.
stand here in the middle.
Thank you, thank you. I can officially say, no, it feels great. It's been a fantastic experience, definitely. Many great conversations were had, and I think our goal this year in particular was to showcase really just the maturity of the space, and this is a very different industry than it was even just 12 months ago, and I think, or I hope that we've managed to achieve that. I personally think that we have, so it's been a real pleasure. And on that note, I know it's, you're a new face on the CV Summit stage. It's been such a pleasure to welcome you for this particular edition. And it's exciting because you're someone who also personally is also involved in the space with your own projects. I know you shared a very sort of brief introduction when you first kicked us off at the summit, but I would love to just ask you to share, just 1 to 2 points on what you're doing over at Planet IX, because it's a fantastic project. Once she's shared, do make sure to go over to their YouTube channel because they have probably some of the best gameplay
we'll see
videos.
if we can actually have a video.
Perfect. Some of the best gameplay videos to give you an idea of what it is that they're building, and it's just Hollywood production. Hats off to you, because I know what it takes. So please do share a bit about what you're doing over at Planet IX.
Well, just as a summary, and it's actually quite interesting based on also the panel that you had now, because this is a blockchain-based NFT strategy game. We call it Planet IX. And it really came about from us, the founding team, who wanted to create something that can be, entertaining, educating, and empowering, and still be a trading game where you can earn money, but really contributing also to, a regenerative and flourishing planet. So in an essence, we've mapped the world with 1.6 million picks, each an NFT, and that can be traded in tiers. And, today we've been under the radar because we've had such exponential traction that, we really want to conceptualize it all. And today we're the largest NFT game on Polygon mainnet, at least if you look at measuring contact interactions. Since our launch on chain in November last year, we've released, I don't know if we can maybe see the cargo that we have now, but we've released airdrops. This is an example of our latest cargo drop. Just showcasing some of the in-house assets, and all of this is done in-house. Mission Control we just launched. So I just wanted to give you a taster. We are a team of 50, 48 of us are in Stockholm, and best within crypto, within financial. CEO comes from private equity, engineers, IX development, front and back, and of course the video production is absolutely eminent. But it also has a core to it. I mean, we have a dedicated Discord group of already 60K and very active community. We have 250,000 connected players. We call them agents of change on wallet, and 171K of our IXC token holders. And our IXC token is on a variety of marketplaces and so forth. So that there's a lot happening, and we are team member funded, speaking of the panel. So what we're actually looking for now, when we have this exponential growth, is more the smart money that was talked about, to really collaborate and accelerate us in this growth journey. And I just want to add, because what I do, I'm head of sustainability. So the whole incentive that we've also brought into the game, we call it syndicates of change, where we can actually put NGOs and sustainable ventures on chain, create an NFT asset in the game, and the revenue derived from the trading goes back to the NGO. So we've done one with One Tree Planted. We donated 300,000 trees and so forth. And we have a foundation that we just founded here in Zug.
Yes, so another one to add to the mix. No, it's a pleasure. So I'm thrilled to have a woman working in the space that also gets to host the summit. So on behalf of myself, of the CB Labs team, of the CBDC team, a huge, 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 huge thank you. I hope on behalf of the audience as well. So please.
Yes, just one last summary. I think it's good to give it up to Mathias as well. I mean, the CEO of CBC, both of you are such great initiators of the CB Summit, and you've been sitting at the forefront here all day today. So Mathias, you're the perfect person to sort of round it all up.
Thank you so much, Sabine and Tracy. Unfortunately, this is a very rare picture that you can get right now on the stage of blockchain and technology. Women are in the majority.
The women outnumbering the men.
And I'm very blessed to have been working with you, both of you. Thank you so much. Well, Sabine, I like to be inspired on these conferences, as I told you. And inspiration for me is something that, you take home and you go to bed and then you wake up with 100 ideas. I'm sure that's going to happen tomorrow, but then also sometimes you have some facts, right? And then I take notes, and I took notes throughout the day from people that I met, conversations that I had, panels, and just let me a few ones that really stood out to me. I was talking to someone, and it really became clear that because we're all so depending of each other in the space, it's an ecosystem. You can't just be a lone rider and do your stuff. You have to be connected to the others, to the corporates, to the legacy world, to the new world. I think that's a good thing to start off with. And what I also found very interesting, someone said in the DeFi panel that DeFi is not the problem. It's the actors, right? And I think that's very true. Then I learned there's something called self-sovereign finance. I've never heard that before, so I thought that was interesting. Dynamic NFT, anyone? I think that's really interesting. The link was made to identity, you know, that you can kind of create your identity over time based on NFT technology. I thought that was very interesting. The metaverse, I still don't know what it is. Don't know about you, but what I thought was interesting, the CEO of the Web3 Foundation said, actually, we were living in a metaverse since the COVID bubble, right? I think that's not so wrong, you know? So you're using much more technology through the pandemic. And then, of course, for me, the whole Africa discussion is, of course, absolutely relevant. And Gideon said something, not sure if you heard that, right? He said, Africa is the new Bitcoin, you know, and he, of course, refers to the potential of the upside of the continent, you know. If you listen to the panelists, there's actually, if you can wait for 10 years, there's only upside, right? There's tons more, right? What I would like to say with an ending statement is I really think that the space is professionalizing. I think that everybody that I talked to today said so. And, you know, not sure if everybody really understood what happened today with the merge, right, this morning, right? It was a successful merge in a decentralized organization that took years to prepare, and it went smooth, you know? Someone said it was boring, and I think this time boring was really a good thing. And really, I would like to call out on the incumbent industries to no longer hold blockchain tech in probation, but to embrace it, because the risk is that you're going to miss out and be on the losing side.
Such a great summary. And on my behalf, I want to thank for the opportunity to be able to facilitate these 2 days. I want to thank all of our audiences who have been here during these 2 days, the teams, the installations, and of course, our online audience. And remembering this is a collaborative process. We're in this together. And the quote that we started with was, creativity is intelligence having fun. So let us go out there and be intelligent, creative, and have fun. Thank you very much.